Financial Summit expert question and answers. Today, you're getting a triple header. And right off the bat, I need to apologize for making that as confusing as possible in the email this morning. For those of you who opened the email and were a bit confused, that's on me. I had 11 p.m. instead of 11 a.m., and then there was some confusion about who was presenting when. I thought by putting the three of us together and having one day that it would make it less confusing. But apparently, I'm my own worst enemy. In any case, I'm here. I'll be taking your questions for an hour on DIY retirement planning. And if you're asking, hey, Kyle, what makes you a DIY retirement expert? If you're not aware, I wrote a course called worryfreeretire.com over the last probably almost 2 years now between researching and writing about it. I had it looked at by several financial experts, including Jason Heath, who will be on later. They critiqued it, helped me proofread it. So I feel like I've got a pretty good grasp on it. And then in an hour, Jason will be coming on to take financial planning questions from all comers, from whatever sort of field you want. And then we're going to wrap in the third hour by talking to Nancy Grouni of Objective Financial Partners. And Nancy's going to be looking specifically at corporate planning, which we've already identified from a lot of the questions as an area we're going to dive into a lot more next year. And I see we've already got some questions coming in here, which is great. I'm going to, for the first few, I'll kind of answer a question, and then I'm going to bounce back and just kind of relay. So all the new people coming in over the first few minutes, it's like a teacher reflex, I think, for all the late kids that come in after the bell rings, to kind of catch people up and say what we're doing. So JL, apparently I ignored JL the last couple of days ago on our last session, which I greatly apologize for, JL. His first question is, he wanted to know if the fees for the summit or retirement financial planning are tax deductible. Retirement financial planning, as far as I'm aware, would be tax deductible. Now, that would be a question. Maybe you want to repeat this again when Jason comes on, just to make sure. But as far as the financial summit, as far as I'm aware, I've never asked the Canadian Revenue Agency before, JL, but I would guess not. Now, maybe if you were, as a part of your day job, you were managing money in some way, or you were advising or coaching, maybe you could deduct it as a business expense. But again, no official reading from the Canadian Revenue Agency on that. But usually for financial planning, yes. Also, JL asked, does the CDIC, and I'll pop his question up here, does the CDIC cover 5 or more GICs of $100,000 each in an unregistered account if they're invested with different issuers? So, for example, they're all in one bank account, but with various institutions. So I'm pretty sure what JL is asking here is if you open a brokerage account, so not a bank account per se. I'm not sure what the logistics would be there, JL, if you'd like, say, open a high interest savings account or something at your local Big Five bank and then got GICs from multiple banks. I don't know that that's possible. I've never tried it, but I think what you mean is, all right, I've got an unregistered online brokerage account and I've got a 3-year from RBC and maybe a 5-year when I logged in, a 5-year from EQ or whoever had the best rates. And my first instinct was actually to say, boy, I don't know. I think that's all one account. But then I remembered that Rob Carrick of the Globe and Mail had actually written about this a few months ago. And he actually emailed the CDIC, and those are separate individual accounts. So in your hypothetical situation that you have there, JL, this is based on Rob Carrick and his emails with the CDIC. All $500,000 would be CDIC insured at that point. So hopefully that makes sense to you. Okay. As always, sorry, I said this at the top of the last session. I just assumed everyone had tuned in. If you have questions or comments, type them in on that YouTube screen. They're going to pop up here on my screen for me, and then I'll do my best to freewheel here. I'm moderating for myself for the first hour, so just bear with me if I need to take a little water or need to take a little break. All right. Excuse me, Jack. Jack says, what would a good mix of fixed income and equity be for a 70-year-old with a $5 million net worth? Well, first of all, kudos to that 70-year-old, Jack. Hopefully that's you for having a $5 million net worth. The honest answer is, Jack, there's so many variables that could come into play here. And I should say right off the top that I'm going to shamelessly plug my course at worryfreeretire.com. And the reason I'm going to do that is because I spent hundreds of hours putting together charts and graphs and videos and referencing where I'm pulling this from, academic journals and Rob Carrick columns and various different authors all over Canada, Fred Batiste, Jason Heath. I read, I think, pretty much everything that some of these folks have written. Ellen Roseman was another. And so you're going to hear me say that's a very nuanced question. I go into it in depth in my course. And of course, I'm also encouraging people to buy my course. I'm just going to be transparent here. It's a full money back guarantee, so I can be transparent about promoting it. And so, Jack, there's many factors. My first question to you, if I was going to answer this, would be, hey, what's your goals? What's your goals for this? Right? If you just need to generate 120 grand a year in income to be quite happy and meet all your goals, man, let's just put it in some CDICs or GICs and fixed income products, and you'll meet your goals, and you'll have essentially no risk unless the entire government of Canada were to collapse, and you're off to the races. If you say, look, I want to maximize my statistical probabilities of having a higher net worth upon death, whether that's for an estate or whether you just have a relatively high risk tolerance and you want to get the most bang for your buck, so to speak, and you trust the numbers, you trust the math, obviously that would change it. Truth be told, there's, like I said, everyone's risk tolerance is different, everyone's goals are different. And so I think the only person, Jack, that could really answer that is you. How have you reacted? Have you been invested in the past? How have you reacted when, if you were 80% invested in stocks, say, how did 2008 treat you? Did you lose sleep at night? Because if you have anxiety at the thought of your investment portfolio losing 3 or 40% of its value, that would be a sign you have too much equities. Furthermore, fixed income, if you looked at bond funds the last few years or the last 2 years, they haven't been on a very great run. So you look at the trade-offs between, like, say, a bond ETF, which is a bond fund, and a GIC, and sort of the pros and cons of those in regards to your fixed income. That's the path I would go down. Those are some of the trade-offs involved. But the truth is that if you go to any advisor and they tell you they know the exact answer to this question without getting your response to all those other questions I just outlined, run away from them. Actually, and before we even get into that, Jack, we didn't even talk about how much this net worth is in your house. If that's 5 million in investable assets, if you have a house aside from that. So all these questions, you are going to be a very attractive candidate to a lot of financial advisors out there because of your high net worth. Make sure that they ask you those questions and have a solid educational component for you before you commit. Okay, I'm going to take a sip of water here, and then we're going to get to Cheryl. All right. So Cheryl asks, hi there. Any thoughts on private wealth management firms? Some of the returns seem too good to be true. This one courting us currently invests in private markets. So, the term private wealth investment firm, that can mean a few different things, Cheryl. And private markets is a bit of a separate thing yet again. So a private wealth investment firm can really be almost anyone that owns, that's not a publicly traded company that provides financial advice. A lot of these titles don't have precise definitions in Canada. So I guess before I address the private markets thing, I just wrote an article on $1 Million Journey, which you can check out, that checks my criteria for how to choose a financial advisor and get financial advice in general. So that would be my first sort of go to that. My next piece would be anyone that's taking a percentage of your investments, just run away from them. I don't know how else to put this. I've been hearing for 10, 15 years, various different explanations for why we need to take a percentage of people's portfolios, whether that's a percentage of the overall portfolio or percentage of the funds in the portfolio. I don't believe in it. I don't believe that is a responsible way to manage investments. And so that would be where I would begin. Now, if we're talking about, which I think is what you're getting at here, Cheryl, if we're looking at private funds, and we're looking at, like, say, we're not looking at ETFs, we're not looking at publicly traded funds or mutual funds that trade in only like stocks and bonds that everyone has access to. I honestly think they have a tough time justifying their fees. I've listened to a lot of information on this. I read a lot about it. Ben Felix has done a lot of work on this over at PWL Capital. Some really interesting interviews with guys like Larry Swedroe, some of the folks who have helped build up the Yale and Harvard endowment funds, which are probably the best private market, long-term private market folks that you're going to find. I honestly don't think it's worth the increased costs, and I think that maybe 20, 30 years ago, there was some inefficiencies in that market that smart people could harness, and get some outsized returns. But there's more and more competition in that market, which to me means that all those competitors are going to try to outsmart each other, and there's no more low-hanging fruit. So personally, I would not recommend it at all. I don't know that. Maybe there might be certain elements of it. I'd have to look in terms of diversifying a massive portfolio, that you might get some benefit out of just diversifying with certain other assets. But that's not my cup of tea. I just don't think the juice is worth the squeeze there. I would keep it simple. And you feel free to, if you want to re-ask the question to Jason when Jason comes on, but that would be sort of where I would be headed. I'm just gonna scroll down here and see if anyone followed up. Okay, I'll keep going. You guys have some great questions coming at me today. Things were a little quiet on Thursday, so I'll just keep right on going down. Nancy asks, has the retirement income funds, or have retirement income funds such as VRIF been successful? I guess that depends what you mean by successful, Nancy. There are many people investing in them. How have the investment returns been? Again, those are for the most part they're passively indexed funds from Vanguard. In the case of VRIF, they're not completely passive in that there is like covered call components that are used to uh, boost the floor and lower the ceiling of those investments. And what I mean by that is, without getting too much into like how these guys are using options trading, they're you can use different financial instruments that say, if the stock succeeds above this point, we're not going to participate in that. And in return for that, we'll get a little bit extra on the bottom line. And so companies will offer this trade-off to you. And so those basically things like VRIF, funds like VRIF are using these sort of mechanisms to boost the bottom line. So in my opinion, they've been successful in terms of giving the Canadian market a lot of options, and they've been able to sustain their dividend that they want. Some folks would say it's not a pure dividend because there is some return of capital there. And I think last I checked, I did an interview with on Million Dollar Journey with the Vanguard folks. I forget the gentleman's name at the moment, but he was responsible for part of the creation of VRIF, and he said that they aim to return capital no more than once every 5 years, which only is really important in that it will affect your tax return if you have VRIF in a non-registered account. So have they been successful? It's not really a matter of stock picking. They've been successful. They've done what they're meant to. They'll take your money and efficiently spread it out over many different stocks and bonds, and they'll sort of boost that minimum return. Yeah, I guess that's where I stand on that, Nancy. Would you be better off long term, statistically speaking, in just a basic bread and butter regular ETF like VBAL, to use a comparable? Probably you would, just because that ceiling on stocks more often than not you're going to go through it, but that's long term. And most folks using something like VRIF really are looking for retirement income that's more consistent. So that's a trade-off they're willing to make. But that would be the difference between something like VBAL and VRIF. Hopefully that answered your question. Okay, Sean. All right, Sean he and his wife are both teachers, two people after my own heart. Obviously, my wife and I are both teachers, for those of you that don't know me. We plan on retiring at 55 and 52. Well, kudos to you, Sean. We plan on taking my pension and likely commuting her pension. Are we able to take money from her Lira LIF before 55? You know what? Jason is a Lyra Lift expert. So I'm going to ask you, Sean, to retype this question in back when Jason comes, because he's going to be able to tell you all the different things. Um, my thoughts are, it's either 50 or 55. I forget on what the regulation is off the top of my head, and without googling it here. I am curious if you want to follow up with Jason, and there is kind of a dead spot later, and we have time to take multiple questions from the same person. I'm curious why you decided to take one of you take your pension and the other of you take a commuted value at 52. You could, just so you're aware, if you're not aware, Sean, I'm not sure how this was described to you, but your wife, we are able to take her money. Okay, just making sure I got the respective ages right. Your wife could wait 3 years and still get her pension. It's not a matter of like her commuted value would somehow be less, or something like that, or that just because she wouldn't get her full pension at 52, that it's not worth waiting the 3 years until 55. I only ask because a lot of people would love and are very jealous of folks in our position with two possible defined benefit pension plans. So I'm just kind of curious on that. So check back with Jason in regards to that. But it's either 50 or 55 that you can access that money, but I can't remember which off the top of my head. Sean, okay, Sean furthered up here. I'm just scrolling down, guys. If you're like, why is he just repeating this? I'm just scrolling down and answering as I get these questions. I heard we can unlock some of free Lyra and put the money in an RSP. How do we do this? We are in Alberta, if that makes a difference. Yep. I'm going to recommend Jason on this one, just because he's an absolute genius on the Lyra stuff. I ask him any Lyra questions that I have all the time. It would be a matter of how much RRSP room you have, first and foremost, and then the regulations regarding how much of your Lyra you're allowed to take out. Okay, SPSP asks, how about the fee CIBC Investors Edge for TFSA? Can they be paid separately? Investors Edge says it has to be part of the TFSA amount. I'm not sure which fee you're referring to here, SPSP. Yeah, sorry. I'm assuming that CIBC Investors Edge wants to take some fees from you in regards to the accounts that you have. My answer to this, SP, is go check out our online brokerage comparison at $1 Million Journey, and then choose a broker that doesn't have fees for accounts, and then you don't have to worry about it. Okay, Aditi asks, how can we find your course? Aditi, head to worryfreeretire.com or .ca. Either one will bring you there. Or just Google Kyle Prevost retirement course, and either one of them will pop up. You can also check out, if you Google Kyle Prevost retirement course, you'll see I've done a bunch of interviews. So obviously, if you ask me if the course is good, I'm going to say yeah. But folks like Ellen Roseman has interviewed me, Mike Haro has interviewed me, Cornell Schreiber. I've done several interviews in regards to the course. You can see what these folks. There was in Money Sense, Jonathan Chevreau did a thorough review of the course. I gave him a review copy or login of the course, and you can see what Jonathan, who's been writing for multi-decades, has thought of the course. So don't take my word for it. See what these folks who've kind of seen a lot and seen a lot of attempts to sort of help people out, see what they think of it, and make your decision from there. Okay, Corinne asks, what are DIY retirees doing with their investments as they age and they don't want to manage it, or they can't anymore? Corinne, that's a great question, and I think it's one that it's not one that we talk about enough, because it just sucks to think about, right? What we're addressing here is preparing for cognitive decline, and it's kind of inevitable for most of us. For enough of us that we should be planning for it. And we don't like to talk about it because that means we don't want to plan for it, because it's just not fun to consider. Now, there's many different ways to do this. And I don't think one is more right. I think it's what is most comfortable. I will tell you this, Corinne. Before I started researching my course, I had a negative opinion on annuities specifically. And if folks aren't aware of what an annuity is, I describe it in the course as essentially buying a pension. So I was obviously very familiar with a teacher's pension, being a teacher. And folks would say, "Oh, you guys are pretty lucky," and I'd say, "Okay, well, let's buy an annuity. You can purchase my pension. Not quite apples to apples, but close enough to get a general idea of what an annuity is." And I really think that the more research I did, the more I liked the idea of annuitizing a solid chunk of your retirement nest egg for most Canadians. Depends what your goals are, depends what your assets are, depends what your comfort with risk is, but that annuity is going to be a guaranteed chunk of money that hits their account every month for the rest of their life. And if you do a joint annuity, it hits either you or your partner, your spouse. It'll hit their account or your account, whoever last living, their account for the rest of your life. And that is one way to mitigate the risk of, like, I don't want to be worrying about selling portions of my ETFs as I age in my upper 70s into my 80s. Another way of doing this that I became more and more, the more smart people I read, the more I agreed with the idea of deferring your OAS and CPP. And so what that would mean, Corinne, is using more of your own investments to fund your retirement up until the age of 70, or whatever age you were able to defer to. It could be 67, 68, 69, 70. And by doing that, it's kind of like an annuity in and of itself, guaranteed by the Canadian government, because you're guaranteeing yourself a larger CPP payment. And so in doing that, hopefully at the age of 65 to 70, most of us are pretty confident in our ability to manage our own investments. And, we can take out of our RSP or draw down our RIF or whatever we want to do, however we want to proceed with that. In the knowledge that once we hit 70, we're going to have a pretty big chunk of change coming to us, guaranteed at that point. And again, the point of doing that, one of the big advantages would be you hit 85. Who cares if you have a lot of money left in your non-registered account or your investment portfolio at that point, if your goals are being met by your increased CPP and OAS payments. Now, assuming you don't want that, that's not your cup of tea, the annuities and the deferment plans. I've seen some interesting recommendations. Rob Engen, who's worked with dozens of Canadians at this point, he's talked about how folks are actually using robo-advisors for this. And what they do is, when they feel that time has come, that they want some help, they transfer their portfolio, and oftentimes they can get the exact same equities and fixed income balance that they had in their personal online brokerage account. And they just tell the robo-advisor, sell this much every year, rebalance, or every month, send me a check. And most robo-advisors in Canada, the bigger ones at least, are able to do that. And they'll just do that till the money runs out. And obviously, if you want to change it, you can. I don't know. We have an extensive article, again, at $1 Million Journey, talking about how robo-advisors are set up. But this kind of is contrary to what a lot of people think. Robo-advisors are kind of for more tech efficient, maybe younger people who are a little more comfortable doing it. But Rob said he's had a lot of success recommending this to people who want like a less hands-on solution as they age. So those would be sort of my main recommendations, Corinne. Hopefully that helps. Jack says, thank you, Kyle. Can you provide a link to your course? There is probably a way, but I'm embarrassed to admit that I don't know this platform that I'm on here. It's not the YouTube platform specifically. It's a separate one that I then use to stream it out. So like I said, just Google Kyle Prevost retirement course and it'll pop up right away. And then you can see what other people have said about it. Okay, Cassandra asks, I've always thought that it was best to max out the TFSA before the RESP. However, is it better to do the opposite to get more of the Canadian child benefit? How do you need to invest to even make that worth it? So the CCB, I'm gonna assume, Cassandra, I'm gonna look here in the column. Cassandra, CCB, you're referring to the are you the Canadian Child Benefit, or are you talking about the match, the 20% match that comes on your RESP? Our RSP. Got you. Okay. I thought we were comparing saving for a child's education there. Okay. So You thought it was best to max out TFSA before RRSP. However, is it better to do the opposite to get more CCB? How much do you need to invest to even make that worth it? Great question. So just to kind of paint, I know Cassandra only got I think it's 200 characters to describe the situation there. By contributing to your RRSP, you're going to lower your taxable income for the year. And obviously, as Cassandra probably knows, the lower your taxable income is, the more uh, Canadian Child Benefits or things like eventually the OAS, but means tested government programs are all a lot of them are based on taxable income. CCB being a big one. And so what we'd have to do, Cassandra, is look at your specific situation. It's not a matter of the investments. It's a matter of the the CCB clawback as you climb up that income ladder is substantial, especially if you have multiple children. So it acts almost like an increased tax rate. And so how I've described it to my friends with children is you can lower your marginal tax rate is often like 50-60%, depending again on what income level you're at. And so then it can definitely make sense to contribute to your RSP, because the refund you're going to get on that is large, because you're paying such I shouldn't say a refund. Your refund will be the same, but you're going to get an increased Canadian Child Benefit as a result. So your combined refund plus your increased CCB is going to probably be pretty substantial, because that marginal tax rate, I'm calling it a marginal tax rate, your tax plus your clawback is so high. But again, it just depends. If you're at the high end of the scale, it probably isn't going to make much of a difference. The investment side of things, off the top of my head, I can't think that it would change all that much, whether it was in your TFSA or RSP. Maybe you'd look at possibly in your RRSP, maybe putting some U.S. equities that wouldn't be taxed as beneficially as in your that would be taxed more beneficially than in your TFSA. But that would be about the only difference, assuming your risk tolerance is the same, obviously, for either account. So that would be my thought on how to sort of balance that, or how to do the math on that. You just have to Google like CCB thresholds or CCB clawback, and see how we had Ed Rempel did a talk on this a couple years ago. So you could look at past episodes. If you have a product, we're going to be releasing some of the back seasons of the Canadian Financial Summit here shortly. And if you buy that and you check out Ed Rempel's talk, you'll see he details just how expensive it can get for people to earn money if they're in some of the lower tax brackets. And as they climb, the government will claw back that benefit. So yeah, I might be repeating myself, but there's a few elements to that I just want to make sure. And I think that would probably, for most people, tip the balance in favor of the RSP. Okay, Glenn asks, I recently listened to you and Cornell on his podcast. You mentioned investing within a corporate investment account with Horizons ETFs, taking dividends and turning into capital gains. Could you please expand? Okay. So Glenn, I talk about this quite a lot in my course. And there's two main groups of people that I know that use these ETFs. And they're people investing within corporations and expat Canadians. And the reason this is they're called swap-based or total return ETFs. So if you Google swap-based ETFs or total return ETFs, that's what you're going to come up with. I'm not sure if Horizons is the only one. I know Horizons was the first one, and they're the ones that I have personal experience with. But basically what this is Horizons goes to a bank. I think it used to be National Bank of Canada. I don't know if it still is, but they go to a large institution and they say, look, what we're going to do is we're going to swap at the end of a specific period of time, whether that's a month or a quarter, I'm not sure. We're going to take something like the S&P 500 or the TSX 60, and we're going to look at what was the capital gain. So let's say for the year it was 6% with 3% dividends. And instead of saying 6% and 3% dividends, we're just going to swap, and you're going to give us that total return all at once. So effectively, it acts like a capital gain. And I don't even 100% understand the exact logistics of what happens in the swap between Horizons and National Bank. But I do know that what you end up with is the total return, almost exactly the total return, minus a very small fee, of course, for the bank, which is doing all this money shuffling. And so what ends up is there's no actual dividends hitting your account. And this doesn't matter in a TFSA or RSP because you're not being taxed anyway. Doesn't matter, right? But within a corporate account, or if you're an expat, Canadian companies paying dividends you're gonna have to pay a tax rate on that as well, withholding tax rate. Uh, so you no longer will have to worry about that, paying tax on that within your corporation. Instead, you're going to have a total return ETF where everything is now a capital gain, and it allows you to defer that taxation and possibly pay a lower tax rate. So that's why I've just given this like the most surface level response because I obviously want to answer more questions here. But if you want to look further into it, look at swap based or total return, and that's the gist of how that's done. Okay, Susan says, we've made stupid investments in the past, Nortel, and we're in our late 50s with minimal retirement savings. We're debt free except mortgages and are ready to start, but I'm paralyzed as to what to buy. Well, first of all, and I mean this very seriously, Susan, congratulations on asking for help because I can guarantee you there are thousands and thousands of Canadians or people all over the world, just like yourself, who've made a mistake or an error here or there, and they've never reached out and they're just going to suffer the rest of their life for it. And so thank you for the question and kudos to you for looking into this and getting started. We always say there's the classic phrase like when's the best time to plant a tree was 100 years ago, and the second best time is today. So if you're planting a money tree, the best time was maybe when you bought Nortel, but the next best time is today. So paralyzed as to what to buy. This is a massive, massive, massive question. And this is I hate the salesman talk, but I'm going to be a little bit salesy here with my course and say my course, honestly, Susan, is going to take you through step by step, and it's money back guarantee. If you come to me, and I've already given a couple refunds of people who just said I actually, something happened and I need the money back, and it was within a week of buying the course, and I've refunded. So I'm a little salesy with the caveat that I'm not just going to take your money and run. But it'll take you step by step through, okay, let's learn what a bond and a stock actually are, right? Or a GIC actually is. What are those things? Like, but I'm not going to give you the best and hottest stock tips and what to do. I'm going to say these are the building blocks of a portfolio. Here's what a fund is. It's a collection of these different assets. An asset is just a fancy way of saying something that makes you money, right? And here's how they're organized, and here's what the math says, here's what the studies say, and here's how you should arrive at how to construct your portfolio based on your personal risk level. And I think it's worth it, even if you were to go use a financial advisor after, simply because you'll know if that financial advisor is just trying to sell you stuff, or if they're actually educated enough and good enough at their job to engage with you and understand you personally as a client before they start recommending products to you. Otherwise, you're kind of just walking in the dark, hoping you meet someone, hoping you get an advisor that is good, and you'll have no real way of ascertaining. But you shouldn't be putting most of your money in any one stock. In fact, I don't really recommend many people get involved with stock picking. There's a very, very small group of people that love to pore over financial statements and balance sheets. And that's what they just enjoy doing on their weekends and trying to outsmart the market. And maybe for those type of people, a portion of their account makes sense to pick stocks in. But for the vast majority of us, and I'll detail this in my course, we're better with just broad-based index funds that chop fees to the bone and give you the average of the entire stock market. And I'm just going to put a pause in there because when I get going on index investing, I tend to ramble for quite a while. So I'll just leave that there, and hopefully that gave you at least the foundation to start building on, Susan. Okay, Aditi asks, is it a good idea to use a robo-advisor for 10-year investment with medium risk appetite? Do you think their past performance gives 7 to 10% returns? This is a great question, Aditi. So uh, to answer this question, and I get this question all the time, and it is slightly frustrating to me, only in that we're asking the wrong question. Because the real question that you need to decide for yourself is, do you want to be an active investor or a passive investor? And I kind of just had this discussion in regards to, I believe it was Susan's question. Yeah, Susan's question up above. An active investor is someone who says, look, I think that either myself or the mutual fund person that I pick, they can go out into the marketplace and pick the best stocks, the best bonds, and they're going to do better than the average. A passive investor says, look, I just want a little bit of everything and I'll get exactly the average. If the average of the TSX 60, which is the 60 biggest companies in Canada, if the average return that year was 5%, I'm going to get 5% minus like 0.05, whatever the fee is for the ETF. Almost negligible. Okay. Same thing for bonds. And statistically speaking, passive investment is almost always the winner over 10 years. Almost always. Active investors that do beat it have a really hard time doing it again. The reason that active investing still is a thing is because the mutual funds that are active investors, they pay a lot of money to financial advisors who are not fee-based, advice-based. So Jason Heath and Nancy Grouni that'll be on later today, they are not like this. They don't take commissions. They don't take kickbacks. They don't take a percentage of your portfolio. If you go to them, they'll tell you, they'll ask, they'll say, hey, what do you need? And you'll say, here's what I need. And they'll say, all right, that'll be this much money. Just like as if you were going to go to the dentist or whatever, all the other services we buy in society. Most advisors you go to, you walk in and you say, here's what I'd like. And they say, oh, that'll be free, sir. No problem. The mutual fund company will cover that on your behalf. Here's what we recommend. Here's a fancy chart. And you're off to the races. All I know, Aditi, is I have read honestly probably 4 or 5 dozen books on this. I've read hundreds of columns. I am certain that index investing is the answer for 99% of people out there. I use it myself. I recommend it to my parents. I recommend it to my friends. There's a small group of people out there that I think are semi-qualified to try their hand at active investing. And if they're honest, even they have a hard time beating the market over the long term. Now, in answering that, robo-advisors, I think all of them, definitely all of the biggest ones, they are all passive investors. So when you ask, how has the robo-advisor done? That's an irrelevant question because they're all passive investors. They have all done exactly the average of the various funds that they're invested in. So if you go to one of the big advisors and you go through their risk assessment and the two of you agree, okay, I want 70% of my portfolio in stocks, 30% in fixed income. And within that 70% that's in stocks, I want, the whole world stock market, right? And the 30% that's in bonds, I want half of that in Canada and half of it in the rest of the world's governments and maybe a few big companies like Disney. I want some of their bonds in there. And I just want to rebalance and always keep that general portfolio. They're all passively managed, all of those ETFs that those robo-advisors are going to put your money into. And they're going to do it for, somewhere around 0.4%, which is not nothing. But yeah, so I think it's a good idea. I think it's a very good idea for the vast majority of Canadians that are looking at active investing or using mutual funds. I think robo-advisors are very solid. I do think that the all-in-one ETFs that we have now, they have taken a lot of what made robo-advisors special and they've put it in just a even cheaper, much cheaper in some cases, product that you can just log into an online brokerage and buy. So like, Rob Engen has talked about the two fund portfolio he uses, like VEQT, and I forget what his bond allocation is if he even has one. But if you look at VEQT as an example in Canada, and there's other ones, this is just off the top of my head. Again, at Million Dollar Journey, we've written about all of the all-in-one ETFs in Canada, so you can look there and compare them all. But you can do it there, but obviously the robo advisors are going to give you a few other things on their platform that you can't get through just an all-in-one ETF. But that would be my answer to, do I think they're a good idea? Okay, I realize I'm rambling a bit, guys. I'm just trying to balance out here between giving all the detail that each of these answers deserves, and also getting to as many questions as possible. So I apologize in advance. If you're here wondering, hey, when is Jason and Nancy coming? Jason should be here in about 20 minutes. Nancy's going to follow up after that. Nancy's going to specialize in some of the corporate stuff. Just keep firing your questions away, and I'll keep answering them. Okay. Oh, Aditi follows up. Do you know if CIIC secures 1 million for a CIBC account and a Simply Financial account separately? They seem to be in the same parent company. Definitely, they do not, because the CDIC only covers 100,000 per account. So I would think Simply Financial would probably almost assuredly be a different $100,000, but that's what you'd be looking at, Aditi. Okay, SPSP asks, is an annuity still recommended for people with a defined pension plan? Good question. Again, it depends what your goals are. Honestly, there are people out there who, if they could just take their nest egg and turn it into a monthly income and never worry about it again, they're going to be getting, a check from their employer through the defined benefit pension plan, which is, I write about the studies in my book, but it's not guaranteed. But we've had very, very few cases in Canada of companies not being able to pay out their defined benefit pension plan. You'd be getting your OAS, you'd be getting your CPP, and now you'd be getting your annuity check on top of that. And if you've got all those things just coming to you each month, and you never have to log into an online brokerage, you never have to worry about the stock market, that sounds great for a lot of people. Now, mathematically speaking, is it the optimal way to get as much money as possible, or would it have been the best way in the past? And the answer to that is no. An annuity, obviously, you're pooling your money with a wide variety of people, and you're looking at an average, and that company then takes your money and invests it in stocks and bonds and some other different investments, and then is paying you out. The other thing is, there is a risk that you buy the annuity and 3 days later you pass away, and that sucks, obviously, and that is a risk. But I try to explain to people, like, for teachers' pensions, it seems to really ease people's fears when I tell them, because they go, "Hey, if we pass away young, does the government keep all that, or does the bank keep all that money?" And the answer is no. It stays in the plan and gets paid to your colleagues who have subscribed to the plan with you. And they go, "Well, obviously that sucks. I don't really want to die tomorrow, but I could rest a little easier knowing that it was my money going to other teachers." And it's the same thing for annuities. The reason they can pay out a pretty solid return is because they know, statistically speaking, a certain percentage of folks are going to pass away young. And so your money would actually be going to fund, the folks that do live to be 97 or 102. And so some folks, for some, it just depends on how you look at it, I guess. But some folks take a little solace in knowing that's how an annuity works. So I don't think by any means that having a defined benefit plan means you shouldn't have an annuity. But statistically speaking, you've already got a certain amount of semi-guaranteed income coming. The idea would be, mathematically, you could take more risk, but it just depends how you value risk versus that super convenience of having an annuity. There's no right or wrong answer there. All right. CF Prue says, what are your personal thoughts on the current stock market conditions and the volatility over the last couple of years. What are your personal thoughts on DCA, which I believe means dollar cost averaging, or lump sum investing? I mean, this is just a great question because I get to pretend like I'm on the 24/7 news network and I can just like shoot from the hip and say what I think. I write actually every week CF or CFP. I'm not sure how I'm supposed to address you, Mr. Miss Prue. I write a column for Money Sense magazine each week called Making Sense of the Markets, where I do kind of give my thoughts on current stock market conditions and bond markets and housing markets. So you can check out, if you Google like Kyle Prevost Money Sense, you can kind of go each week and see what I think. I don't want to spend too much time on this because the truth is that no matter what my thoughts are, it probably shouldn't affect your investing style at all. Long story short, I think that if anyone says to you that they're sure they know what the market's been doing and where it's going, just quit listening to anything they have to say, because they're trying to sell you something, or they're trying to sell themselves as an expert, and they're an idiot. Because there is no data. We've never had anything like what we attempted to do and did do during the pandemic, where we shut down multiple sectors of the economy of the world's industry, and simultaneously through monetary and fiscal stimulus at our countries. So we have no idea what the long-term effects of this will be. And of course, like, I wasn't really surprised at the volatility, because when you do something that we've never done before, nobody really knows how to price an asset. And consequently, we saw markets go up and down. And there was a lot of, like irrational investor behavior when we're talking about things like cryptocurrencies and GameStop and all those guys. So long story short, go read my column if you want more of these super random Kyle Prevost market thoughts, but they shouldn't really affect your investing long term or even short term. Probably, I feel like if I'm not even using my own, if I'm not even being an active investor based on my own thoughts, I shouldn't recommend anyone else be. But yeah, that would be my sort of random. I do think that if I had to guess, and based on like when I go to write my 2024 predictions column, which I always give the same caveats I just gave, I think my general approach is that it pays to be an optimist. And I write in my course that, like, look, if you look at like the 20th century, if we went through like World War One, World War Two, the Cold War, numerous crazy, like the Cuban Missile Crisis, multiple financial meltdowns, the 2008 subprime mortgage crisis in the States. If we went through all of that, the Soviet Union falling down, so on and so forth, right? If we went through all that and the market got 10% returns, mostly American stock market, but if you look at Canada, the US, we're between 9 and 10%. I like our odds for the future. So that's generally, I try to always keep that as the foundation of what I think. Now, dollar cost averaging versus lump sum investing. The math says lump sum investing wins every time, or wins. It always will win a majority of the time. So, for example, if you look in the past, because of what I just said, because the stock market generally does well and has done well, it pays to have your money in the stock market. Now, of course, the worst fear is you put the lump sum in and the market does bad. If that fear is causing you a lot of anxiety, then go with dollar cost averaging. If you trust the math and you're like, hey, the math is the math, I'm better off putting it in right now, the odds are pretty darn good, then lump sum wins. I personally, for me, would put lump sum. If I were to inherit $100,000 tomorrow, I would put it into my portfolio all at one time, trusting the math behind it. Okay. Oh, follow up here from CF. How would you approach investing if you left an advisor and the assets are in cash and you now want to redeploy into a DIY manner and approximate a 15-year retirement time horizon? Again, this is such a huge question, and you guys are going to get sick of hearing this, but I do go through step by step in the course on exactly how I would approach investing with this. Now, here's the interesting thing. When we talk about a 15-year retirement time horizon, CFP, I'm betting that you mean 15 years until you retire or until you and your spouse retire. Now, here's the interesting thing is you're probably, hopefully, going to be retired for like 30, 40 years. For sure, 25 if you're like somewhere around the Canadian average. So if you think about it in terms of your portfolio time horizon, it's probably like 30, 40, maybe 50 years. In terms of like when you'll be hopefully taking out that last dollar, if your goal is to quote unquote die with zero, which is a book title that from last year. Taking out that last dollar, if you're finished your accumulation phase today, 50 years from now, you have a 50-year time horizon to consider, which might shift a little bit of the risk you want to take. To fully answer your question, I would have to know so many things. What are your retirement goals, right? What does your CPP and OAS look like? How much do you think you'll be spending in retirement? What is your risk tolerance? How have you reacted to losing money in the past? Um, these are all things that need to be answered before we can even look at investments or asset classes. So if you approach another advisor or decide to do it yourself, don't skip those steps that aren't as much fun as like, okay, get to the part where I make money. Um, those things need to be looked at before you start actually choosing investments or zeroing in on a solution. I'm just going to reiterate here, take a second and say Jason will be coming in 10 minutes, and then Nancy Grouni will be on in 70 minutes from now to answer specific corporate investing questions. And she'll probably take questions on other things too, but she was our corporate specialist. So if you're here to see them, hang on, they'll be here. Okay, Kirk asked, how does income splitting work? Okay, that's another big question. Income splitting is the short phrase we use to describe a variety of strategies, usually referring to when we can take an income stream and split it between two members of a couple, each person in a couple. uh, there used to be where you could include children and a corporation and income sprinkling, and so that was what income splitting meant for like certain folks that own small businesses and such. But I presume, Kirk, what you're talking about here is splitting between a married couple, and there's various ways to do this. It depends if you're already retired. It depends if you're talking about like spousal RSP contributions. It depends like if you're talking about if you have retirement, if you have a pension income or an annuity income, uh, basically what they're referring to is the closer that you can get both you and your spouse to earning the exact same amount of money using tax accreditation rules, the better it is for your taxes, right? Because if one of you earns, I'm just going to say like 120,000 and one of you earns 60,000, the 120,000 person is going to have a much higher marginal tax rate, right? They're going to be paying a relatively high tax rate on that 100 to 120,000, and the 60,000 person is going to have room in their tax bracket. So ideally, in that perfect world, we'd meet and each make 90,000, and then we would guarantee ourselves the lowest possible tax rate. And there's, like I said, we're talking about multiple ways of doing that, whether we co-own a corporation, whether we're talking about splitting retirement, whether we're talking about pension income or RIF income. That's what income splitting generally is referring to. And in fact, I know one of the questions I got for the summit was, if I had time to address today, was, why are we always talking about couples? Why aren't we talking about individuals more in retirement planning? And obviously, a lot of the tools that are out there, I sympathize and empathize with single folks, because a lot of the tools that are out there are for married couples, so that they can income split and save money on taxes through doing that. And obviously, single folks don't have those tools available. All right. Susan asks, and again, keep sending in questions, because all that we're going to do is we're just going to keep rolling these right into as Jason gets here. And if I answered a question up above, and didn't get back to you there, or said, hey, make sure and ask Jason when he gets here, you can just re-put it in the feed, and I'm just going to keep scrolling down and tossing them up here and answering them. Okay, Susan asks, is there ever a good reason to convert term insurance to whole life? I have been anti-whole life, but the advisor is recommending conversion over time. You're hitting a bit of a pain point for me here, Susan. Is there ever a good reason? There are certain instances, if you've maxed out your TFSA and you've maxed out your RRSP and you have a corporation and passing along a fair chunk of money in your estate is your number one priority, whole life can possibly work. But I don't recommend it to anyone because it's so few people that meet all those different criteria. And even when they do, the comparison shopping of different whole life insurance policies is so mind-numbingly difficult that to actually get a good deal where there's like low fees, it's just not worth it. It just isn't. And honestly, I'm gonna get in hot water here a little bit, but if you've actually got someone who is pushing you very hard in that direction, despite what you're saying, that's a huge red flag for me, Susan. I honestly, just based on that alone, would probably break up with the advisor because here's the raw facts: that advisor is going to get paid a lot of money um, uh, if they're not a fee only advisor. If they are not just telling you here's a set amount of money that you pay me each month, if they rely on selling financial products to pay for their advice to you, they're going to get a huge amount of money for putting you in a whole life policy. And whole life policies, the first thing that I saw when I started researching it is the vast majority of them are never paid out because people let the monthly payments collapse. Like, it's crazy how many. I'd have to go back and look at the exact statistic, but it's well over half of people don't continue paying until death, and they lose all that money that they put into them. So hopefully that answers your question, Susan. I have to admit I'm biased. I've done the research. I think all of this talk that I see out there with whole life and participating life policies, I think it's all garbage. Honestly, they make it so confusing and complex to just keep your own money and invest it on your own. Um, yeah, maybe if you want to leave behind a huge tax-free estate and you're in a high net worth category, I've seen certain scenarios where it makes sense, but even then, it just comes out slightly ahead of if you just handled your own money anyway. So I think you're in the right ballpark there of term insurance, invest the difference. Okay, Vadik asks, how do taxes work on annuities and non-registered accounts, and how do those play along with GIS? So the taxes on annuities, I've got a thick section in the course about this, Vadik. I also wrote a smaller section for Million Dollar Journey on annuities. If you Google annuities in Canada, Million Dollar Journey, my article will pop up. But it has to do with choosing like prescribed annuities versus non-prescribed, and how those different, how much of it is your own money coming back to you and how much of it is investment gains. Um, that's how generally, if you set it up properly, it's pretty tax efficient, especially in a joint annuity, because again, you're income splitting there. So that's generally pretty well. Now, GIS, I'm virtually certain that that those annuities would be taxable income. I don't know. There might be an annuity product out there of some kind, but off the top of my head, I can't see why that would be now that I think about it. I can't envision an annuity that would not count as taxable income. So that would absolutely affect your government benefits, such as GIS and OAS. So you'll sacrifice, I guess, those government helpers that are for low income folks. Okay, Chris H. In reference to the question about dollar cost averaging versus lump sum investing, if you want to go DCA but have a lump sum, where should it be parked while deploying it, and how to determine how fast to deploy it? So I think the logical place there, Chris, would be you could do two things. You could put it all in a high interest savings account, or if you wanted to get like super optimizing and geeky about it, what I would do is say like, okay, I'm going to do this every 3 months. I'm going to put a chunk in over a year. And so you could put a chunk in today. You could then buy a 3 month GIC, a 6 month GIC, and a 9 month GIC. And just as it matures, take it out, put it in your brokerage account and invest it, would be one way you could do it. That would be how you could dollar cost average. Now, again, I think there's a pretty good chance here Chris H is going to come back to me in a year after he does this, and he's going to say, Kyle, if only I'd invested it all at the beginning, I would have, I don't know how much Chris is talking about lump sum versus DCA, but if I just put it all in at the very beginning, then I would, I'd be so much further ahead. But yeah, so that's the risk you take. Obviously, if the market goes up, you're going to miss out on that. If the market collapses, then you look like a genius. Okay, SPSP. Any thoughts on future direction of our market with average Canadians carrying so much debt? Can we expect another big crash like in the last decade? And I see Mr. Jason Heath just signed in. Hi, Jason.
Hey, Kyle.
Thanks for joining us today. For those of you folks who aren't aware and weren't with us on Thursday, Jason is the founder and director at Canadian Financial Partners. And thanks for joining us again, Jason.
Hey, thanks for having me again.
So I was just fielding questions from all over the place. I had a couple ones on Lira, as I told them, just wait till Jason gets here and he'll get to those. But if you don't mind, I'll just finish off this last one here, Jason.
Yeah.
And this person was asking me to predict the future of the entire Canadian market. So I'm just shooting from the hip, giving my best 24/7 news channel answer. Honestly, SP, I don't worry about it. It doesn't really affect my thought patterns at all because I'm invested in the whole world stock markets. Now, that said, I do have a solid chunk of my money, as most folks who live in a certain country do have a solid amount of their money in the Canadian or in the equities of their home country. And am I worried about it? Not so much, because while Canadians do have debts, Canadians also have a pretty fair chunk of money in assets too, if you look at on a world scale. Can we expect another big crash like in the last decade? Well, I think what you might be referencing is actually the US big crash, because Canada, to the best of my knowledge, did not have a big crash. We certainly did not have a big housing market crash in across the country, maybe in certain regions, if you ask some folks in Alberta, maybe. But Canada didn't have the same subprime mortgage crisis as the USA did. And so am I worried about it? Not particularly, to be honest. There's many things that I worry about more. If China were to attack Taiwan more and we couldn't get semiconductor chips, I would be pretty concerned about that. But I don't know how to build a portfolio for a China-Taiwan war. So that's not something I'm worried about, SP. Okay. Let's throw this one to Jason, because my voice might be almost gone, Jason.
Long morning.
Asks, as I age, I become more risk averse. How would you change your diversified, non-registered portfolio to reflect this? Would you move more investments into index funds, income funds, or something else?
Yeah, it's a good question, Nancy. I do find that, some of the rules of thumb out there about investing suggest that as you get older, you should have more of an exposure to bonds, fixed income. Kyle, I've long heard the one where your age should equal your fixed income. If you're 50 years old, you should have 50% in stocks. Or in bonds, rather. If you're 80, you should have 80% in bonds. If you're 20, you should have 20% in bonds. And I find it's an interesting discussion point, but certainly not something I would prescribe to. I see 80-year-olds who are 100% in stocks. But I think at the end of the day, age aside, I would be most inclined to focus on the time horizon for needing your money. So if you're a young person, you're saving for a home down payment in 2 years, you probably shouldn't have much exposure to the stock market. And risk tolerance. And Nancy, if you're finding that your risk tolerance is changing, that's not uncommon. I've come across a lot of people who are very competent, high risk or willing to accept risk investors with a high exposure to stocks during their working years. And suddenly when they retire, things change. It's different when all of a sudden you're not depositing money to your investments, you're withdrawing it. So it's not uncommon to see that sort of a situation. I think that your suggestion about moving more investments into index funds, I think one thing that I would always tell a self-directed investor, if I assume you're a self-directed investor as they age, there is a real benefit to owning index funds. You don't need to do as much work, pay as close attention to your portfolio and to the markets. If your health were to fail and somebody were to jump in to take your portfolio over for you, it would certainly be a lot easier. It can also be easier when you're in the decumulation phase, when you're needing to pull out $3,000 or $5,000 or $10,000 per month from your investments, whatever it happens to be. It's a lot easier to just press the sell button on a single fund rather than sort of look through and figure out, okay, which one of my stocks am I going to sell this month, and how do I rebalance my portfolio? So certainly for a self-directed investor, I think that investment strategy needs to change as you start to draw down, and what you're going through is not uncommon by any means.
Yeah, that's more or less kind of what we had talked about a little earlier in regards to how to balance out as we plan for cognitive decline, Jason. We talked about someone had asked earlier, and I went over, whether you want to look at annuities or, I've seen some interesting things with robo-advisors and folks setting something up with, which is index funds and using a robo-advisor. Income funds, that's a different one on me. An income fund versus I guess maybe VRIF would be maybe what we're referencing there versus like a GIC ladder. I don't know sort of what your thoughts on that would be, Jason.
Yeah, look, I mean, an index fund, an all-in-one fund like VRIF or some of the other asset allocation options that are available out there, it certainly makes it easier to manage a self-directed portfolio. Frankly, even if somebody is not in the retirement phase, I think there's a benefit if you're going to hold some individual stocks to also having some all-in-one ETFs where, you've got some money that's sort of set it and forget it money, and then you can just focus on, a portion of the individual holdings. Income funds, I think the reference there, Nancy, to income funds is just, insinuating, I suppose, that income funds, like funds that own dividend paying stocks are somehow less risky than other stocks or the broader market. And, I'd be careful about that, because if you look back to the great financial crisis in 2007, 2008, I mean, it didn't matter if you held Canadian banks that paid high dividends, your stocks were down 30, 40, 50%. The banks fell with the rest of the market, and that tends to happen generally. So, I'm generally a bigger fan of a broad-based portfolio that has some dividend paying stocks, some stocks that are more growth stocks, and not focusing so much on income funds. But I think broadly speaking, starting to de-risk your portfolio if you're starting to feel a little bit less comfortable with the volatility of the markets or with just stock exposure as you age, that's fine, especially if you're are in a position where you don't need to earn a high rate of return on your investments, and your portfolio doesn't need to work as hard.
If you're just tuning in, Jason Heath is with us answering questions. I just kind of freestyled solo here for an hour talking about DIY retirement questions. Jason is game to take your any financial planning questions from sort of whatever angle you guys want to throw the curveball at him here. And Nancy will be on in about 50 minutes to take a specific look at corporate planning from a personal finance angle. Okay, Cassandra has, and please keep putting your questions in. You guys got the hang of this. They're coming in, great questions. Just type them in that YouTube comment question section, and we'll just answer them as you guys ask them here. So Cassandra says, my child has a large sum of money that is currently in a high interest bank account. I'm looking into informal trusts. What are the pros and cons? Is the money locked in until they're 18? What are the tax implications of this? That's a great question for Jason.
For sure. So just to walk through the implications here, there's two types of trusts that you can have for a minor child in Canada. You can have a formal trust, and a formal trust is a trust that is established with a lawyer, typically an estate lawyer, that prepares a trust deed. And there are trustees who are in charge of the assets for the beneficiaries, which can include minor children. A formal trust takes time and costs money to set up. It might be $5,000 or more to establish the trust in the first place. And then on an annual basis, you need to file tax returns and prepare trust minutes. And there might be, $1,000 or $2,000 a year of ongoing costs. Normally, people don't set up formal trusts unless you're doing it for really significant amounts of money, like hundreds of thousands of dollars. And, depending who you talk to, maybe even more, maybe even $1 million or more. Informal trusts are obviously more common because they're a little bit simpler. You don't need to go the route of having a lawyer involved. Some banks and investment companies will allow you to open up an informal trust for a minor child. And an example might be if you're opening up an account and you're buying them, some shares or mutual fund or something like that. And it's an informal trust because, again, there's no legal trust deed that establishes it. It's just sort of notionally putting some money into an account for them. When you do that and you have an informal trust account like you're considering, Cassandra, pros and cons. I mean, one of the pros is it's simpler and cheaper than going the formal trust route. One of the cons is that you have less control over it. Once a child turns 18, that legally becomes their money, whereas a formal trust, you can have more control and restrictions around when and how and if the money is even distributed to that. One thing to be mindful of on the tax implication, just take money and put it into an account for a minor child. The attribution rules apply. So generally income, like interest and dividends that are earned for an informal trust account or even a formal trust account, if it's not set up properly, get attributed back to you as the parent. They get taxed on your tax return. So if you open up a savings account, buy a GIC, buy some stocks, buy an ETF, the income generated will generally get reported on your tax return, not the child's. Capital gains, on the other hand, are not attributable to a parent. So capital gains, you buy a stock, you buy an ETF, a mutual fund, whatever the case may be, and you sell down the road, that capital gain is not taxable to you, it's taxable to the child. And if the child's income is low enough, which would generally be the case where they're below the basic personal amount of about $15,000, they don't literally need to file a tax return. So informal trust accounts can work well for small amounts of money, less control. Bigger amounts, consider a formal trust. And one other little nuance, if you have an informal trust with more than $50,000 of assets, which in my opinion is a pretty big amount of money, you may need to file a trust tax return starting this year. The rules have changed on trust tax filings for 2023 and onwards.
That was very thorough, Jason. Very impressive on that. Yeah. So basically, what you described there—that's actually a substantial difference. Then, if you were looking at some semi-niche planning with like a swap-based ETF or something like that versus the money sitting in a high-interest bank account, you could be looking at a lot of difference on your personal tax return as the parent.
Oh, for sure. If you can tilt an informal trust account towards capital gains, then you might be in a position where you can legitimately split income with your child without having the complexity of setting up a formal trust. I think the only challenge is that, in my opinion, before a parent considers setting aside money to open up an informal trust account, I'd be aiming to, consider paying down debt, maxing out your own RSP, TFSA, making sure the child's RSP is maxed out. Yeah. Might be different if it was like a gift from a family member, or it's earnings from their job or something like that. Then obviously it's their money. And if you want to do something where it's earning more than, interest income, then certainly informal trust accounts are an option.
Okay, excellent answer. Now, this is Sean. He and his wife are both teachers, and he'd asked before, and I kind of gave some surface level thoughts I had, but I wanted to get your opinion, Jason. They plan on taking his pension, his teaching pension, commuting her pension. She's 52. Are they able to, first of all, are they able to take money from her lira before 55? And secondly, said, I also heard that we can unlock some of her lira and put the money in an RSP. How do we do this? We're in Alberta, if that makes a difference.
Good question. So a couple things. First of all, if you are on the fence about, and maybe just to back up a minute. So if somebody has a defined benefit pension plan, some pension plans allow you to commute your pension. And if you retire or leave the pension plan, in some cases before a certain age, it might be age related, you can take a lump sum payout from the pension. You give up your future monthly payments. You get a lump sum payment today. Some of it can go into a locked-in RSP account on a tax-deferred basis. Some of it will be taxable to you on your tax return. The pension, they'll do actuarial calculations. They'll tell you how much can go into a locked-in RSP, how much is taxable. And when interest rates were lower, it was really lucrative to take a lump sum payment because the lower interest rates are, the bigger the payment you receive today. Now that rates have jumped, commuted values and taking a lump sum out of a pension aren't as lucrative. Couple of considerations I would have, Sean. If you are considering taking a lump sum out of her pension and just applying for and getting your monthly payment amount, I might question whether that's the right approach, just because women, well, not historically, but actuarially, women live about 2 years longer on average than men. There might be more of a benefit. It could depend on your respective health, but there might be more of a benefit to keeping her pension, given she's likely to live longer than you. So, I mean, that's one consideration, like a life expectancy thing. But otherwise, I think it's a good way to hedge your bets. You're keeping some annuity income that keeps paying out until you're 110, and provides that degree of protection. And you're also getting the benefit of some investment money, so you're not all in pension or investment. In terms of unlocking, I actually can't remember off the top of my head. I live in the province of Ontario. It's different province to province, but different provinces have different rules on when you can access pension money. Most of them are 55, some are 50. Alberta might be 50. Worst case, you might need to wait until 55 to be able to convert her LIRA to a LIF, a life income fund, and start to take withdrawals. But there are also rules that allow you to unlock up to 50% of the amount in your life income fund upon conversion, as long as you do it within a certain period of time. Likewise, I'm in Ontario. I know the Ontario rules off the top of my head. Once you're 55 and you unlock your LIRA and convert it into a LIF, you can take 50% and transfer it into a regular RSP that does not have the same withdrawal restrictions of a locked-in account. Can't remember off the top of my head in Alberta, but Kyle will be sending out, I think, in the next week, about a 30-minute video I did on LIRAs and LIFs and pensions and unlocking, and all the questions will be answered in that video. So keep an eye out for that, Sean.
Yeah, the other thing, Sean, just from my own research, and I leaned a bit on Alexandra. Jason, correct me. Is it
McQueen?
Yes.
Yep.
And Rob Engen. They went over Rob Engen is another blogger, Sean. If you're not aware, he's a writer at Boomer and Echo. He's also a QAFP, and he looked at his specific pension decision in regards to Rob spent a number of years in the Alberta College University pension plan, and they went in depth and looked at the exact pros and cons that Jason just outlined there. And really what it boiled down to me was obviously the personal goals and the whole plan, but do you have any room left in your RSP that you can put some of that that money, that part of the commuted pension that is going to be placed on your annual or yearly taxable income? Because that the size of that one-time payment, that could boost your income, especially if you're working that same year. That can throw your marginal tax rate up really high, depending on how much we're talking. And so if you have room in your RSP, obviously you can just toss a bunch in there, lower that taxable income back down, and it's a little more palatable that way. And the other thing was, how comfortable are the folks involved in investing on their own? Just because, like, if you understand and you're like, yeah, low fee index funds, like you're probably gonna do all right, or at least comparable to likely how the pension fund would have did if you'd left your money in. And the other thing Rob looked at is like, what's the health status of the actual pensioned entity, whether that's a trust or the actual institution. In your case, as far as I'm aware, as far as teachers' pension funds, usually they are provincially mandated by the province. I'd have to look. I know each province
Yeah.
is different, but correct me if I'm wrong, Jason. They're pretty darn safe. Like they're about as safe as any other government pension that I'm aware of.
For sure. I mean, in terms of, it's a registered pension plan that's subject to protections. And I mean, arguably the provincial government would need to get into trouble for the pension plan to be at risk. So pretty guaranteed. But I think you hit the nail on the head that it's a multifaceted decision, and it's tough because sometimes I get a question like that. And it's like, well, how long do you have? I mean, you could almost spend an hour just talking through all the different ins and outs. And one of my favorite answers when it comes to a finance question, it depends.
It depends. Yeah. I tell people, if you don't get a little bit of that, and there's not a like, first I need to know these 3 or 4 things, you need to leave that advisor immediately. If they have the guaranteed best answer, they're a salesperson. They're not.
Very few right and wrong answers. And even something that I would never do myself as a financial decision. There's even a hint. There's somebody out there that it might be good for. So I think you have to explore and consider all factors.
All right. So playing on your trust answer and knowledge here, Jason, we've got JB asks, I opened an informal trust for my 15-year-old son. He's now 22. I'd like to transfer the account to him. Are there any tax implications for my son as the beneficiary and me, the contributor trustee?
So again, because he is over the age of majority, he is 22 now. I mean, technically speaking, the money is already his, and he's entitled to receive it. If you just haven't gone through the process of transferring it to him, no problem, no big deal. Once again, capital gains for a minor child are not attributable back to the parent. They belong to the child. So in this case, even if you bought investments that have gone up in value and there's a deferred capital gain, the investments and those capital gains are technically his. So you would be able to transfer the investments to him, the investment account solely into his name without triggering tax. That differs from other situations where a parent may have always had money in their own name. And if there's a deferred capital gain on an account or a cottage, let's say, a lot of times parents want to transfer something to their kids, more often real estate than investments, and not pay that capital gains tax. There's no way around it. If the account belonged or the cottage belonged to the parents in the first place, there's generally a deemed disposition on transfer that triggers capital gains tax. But again, in this case, because the account was the capital gains belonged to the child right from the get-go, that can be transferred to them, or it's possible the institution might just change the name on the account and not have to change the account number or get into any transferring, but talk to the financial institution.
Okay, great answer. Now, we got one from Vidik here, Jason. Just to give you some background, Jason, Vidik has asked, we've been going back and forth a couple times about annuities. I've been talking about how in the experience of writing my course, I went from being like skeptical on annuities to actually like, I think these are getting to be like a pretty solid option, depending on what your goals are and for a portion of your portfolio, and, touching on what guys like Fred Vitisse have written about. And so Vidik's got obviously a bit of a in-depth math crunching question here. Annuities that are non-inflation indexed, so basic plain Jane annuities, are sold as instruments to ensure against longevity. Yeah, I would argue that's true. But do they actually work, given cash flows from 20 plus years in the future will be massively discounted? I mean, it depends, I guess, what you mean by the phrase actually work. I'll let Jason take it wherever he wants to. I almost slipped into solo answering mode there, but go ahead, Jason.
Yeah, I mean, I will say that I'm a big fan of annuities the theoretical benefits of annuities, because when you think about it, it's almost like an insurance policy, a life insurance policy in reverse. So you buy a life insurance policy when you're like me and you've got young kids and you want to make sure they're protected if in the event something happens to you, and get a lump sum of money for your family. So it's insuring against the risk of living a short life. An annuity, you're insuring against the risk of living a long life. You're buying an income stream that continues for the rest of your life. If you live to 110, it keeps on paying. You win at the expense of the insurance company and at the expense of people who bought annuities from that insurance company and who may have died at a young age. So in practice, I don't see too many people buying them. Most of the real life annuities I've seen during my career were purchased back in the 70s and the 80s when interest rates were much higher. I feel like we're just on the cusp of some changes there, just because interest rates have gone up so much and you've got all these baby boomers that are moving in retirement. But do they actually work given the cash flows are massively discounted? Cash flows aren't exact. I mean, I don't know if that's the right way to categorize it, but if you buy a non-indexed annuity that's going to pay you $1,000 a month for the rest of your life, inflation and cost of living will go up. Your annuity payments will stay stable at $1,000 per month. You can buy an indexed annuity, but if you buy an indexed annuity, the payments aren't going to be $1,000 going up with inflation. They're going to be $700 going up with inflation. And at some point, there'll be a crossover point versus the non-indexed annuity where, your payments are higher. So if you buy a non-indexed annuity and inflation is like rampant in the future, arguably you end up in a position where you may have been better off not buying the annuity and owning stocks and bonds and things that may have provided better inflation protection. But I think the key with any retirement strategy or any investment strategy for that matter is not to go all or nothing. It's diversification. And if somebody is going to consider the purchase of an annuity, typically it's not all or nothing. It's using some money at some point along the way to diversify out of stocks and bonds, and you're not hedging so much against high inflation. You're hedging against long life expectancy. So I mean, to me, it's something that's sort of different.
And one of the other kind of cool things that I read in the research, Vadik, is that folks do tend to up until their final 18 months or so, in general, across averages, folks do tend to spend less. So inflation adjusted, they spend less. Inflation non-adjusted remains about the same as they age. So that kind of takes some of the edge off what you're referring to there, that inflation adjustment. But yeah, if you can tell in advance what interest rates will be, then I can tell you if the given cash flows will work. But if you can do that, you should be working for a hedge fund and paying me a lot more for the summit if that's the case. Okay. Corinne chimes in Alberta. So this would be, again, commenting on Lira LIF. In Alberta, do you need RSP room to transfer Lira or LIF to an RSP? I think that might be due to me not being precise enough in my answer, Corinne, when I was explaining the chunk of money. Jason, what is the term for the chunk of money you get when you have a commuted pension that doesn't go into your Lira, that is an annualized, what's that? I don't know off the top of my head what that amount of money is called that you get.
Nor do I.
Okay, it's a lump sum of money.
I can't remember what they actually say on the pension statement, but it's the amount eligible for transfer up to the income tax act limits. I can't remember actually the technical term, but it's up to the pension plan actuaries when they provide you with a pension commuted value estimate. They'll tell you you're eligible to receive $172,000, and this is guaranteed for the next 90 days or something. And of that, $100,000 is eligible to transfer into a locked-in RSP account. $72,000 is taxable. So it's up to the pension actuaries to calculate it. And the portion that can be sheltered under the limits, you don't need RSP room, doesn't impact your RSP room. It's When you're in a pension, you lose RSP room for being in that pension. You have a pension adjustment on your T4 slip every year. And when you transfer out of the pension, there's a calculation to determine how much can then go back into your RSP without RSP room. The taxable portion, as Cal alluded to, if you have RSP room, you may be able to shelter that from tax by transferring it into your RSP. But again, you need to have RSP room. And one thing that I commonly see with people who are considering a pension decision like that is people will say, well, can I put it in my spouse's RSP to shelter it from tax? Doesn't work that way. It's based on your RSP room. You could use it and contribute it to your spouse's RSP as a totally separate thing, but it doesn't offset the tax. All the income for the taxable portion of the commuted value does go on your tax return for the year of receipt.
Yeah, exactly. What I was trying to get across, Corinne, is there's a difference to your personal bottom line if you have that RSP room twofold, because one, you're going to get the tax refund that year, which again probably is going to be a pretty big chunk of money if you were working that year, plus you got this lump sum from a commuted pension. As well, going forward, those investments, whatever investments you had in the RSP, obviously there would be no tax ongoing on that. Whereas if you took the commuted value and invested the money in a non-registered account, obviously then you have different tax considerations. So it would make it, if you're thinking of all of this on a scale of should I take the pension or should I take the commuted value, it would just weigh on that scale as like, if I got room in my RSP, it makes a little more heavier on the scale of taking the payment sooner rather than later. But there are obviously many different weights on that scale, so one shouldn't outweigh the others. M. Chen asks, what is the best way to help take control of parents' accounts? That's an interesting way to phrase that question. Bank accounts, property titles, etc. as a joint owner versus beneficiary. They need help with day-to-day transactions and tax implications. Jason, I'm wondering if you get this question more and more these days. I know in my personal family circles, this is a very pertinent question, not with my parents, but sort of that next generation up. And when is the right time to step in, and how do you have this conversation? It's almost as much psychological as it is financial, maybe.
Yeah, I could probably spend a half an hour answering this question. I'm going to try to keep it somewhat concise. But if somebody as a child is taking a look at their parents and their finances and say they're starting to have a harder time managing their finances, the most common way to deal with things is that your parents hopefully have in place a power of attorney for property or a similar document. These are provincial documents that have different rules and names from province to province, but generally it's a power of attorney for property that allows somebody, including a child, to take over their parents' finances in some cases when they have lost capacity, for example. And when you're acting as an attorney for property, you have the same ability to do anything that anyone else would do, including, making investment decisions, paying bills, selling real estate, etc. Some banks, lawyers, brothers-in-law, whatever, suggest, get joint on the accounts right away, put your name joint in the house. And I find that's common advice that's given. I mean, that would also allow you to pay bills, manage investments, sell real estate. So there's no advantage to being joint on the account versus having a proper power of attorney. In fact, there are disadvantages, and the disadvantages could be, if something happens and you're joint on your parents' real estate, bank accounts, investments, and you get sued, it may expose your parents' assets. If you go through a relationship breakdown, a family law issue, a breakup, that may risk your parents' finances. If you become incapacitated, you get in an accident, you have a health issue, or you die, that could risk your parents' finances. And it can also expose either you or them to adverse tax implications. It could trigger capital gains tax for your parents. It could cause a real estate property that's their principal residence to lose part of the principal residence exemption that would otherwise cause it to be tax-free. There are new rules for trust tax returns that may require the filing of income tax returns, trust tax returns every year for accounts upon which you are joint. There are new underused housing tax return requirements that could cause a child who is joint on their parents' home or cottage to have to file a underused housing tax return. What else can I say? A lot of times people in Ontario, where I live, will do this in order to avoid probate, which is now called Ontario Estate Administration Tax. Technically, it may not avoid probate either. So, I mean, I said that, what did I say? There's one benefit that you can do all the stuff you could do with a power of attorney. And I think I listed off about 8 or so negatives. I mean, it's not uncommon for this to be recommended, but there can be drawbacks. I think the most important thing is to consider, power of attorney and making sure that anyone at any age and stage has their estate planning documents up to date. And then, having to take over a parent's finances and help with the day-to-day stuff, it's tricky. It's a reality for a lot of people. And when you look at the number of baby boomers right now, it's going to be a big prevalent issue, I think, over the next 20 years.
Yeah, great answer. Weighing the pros and cons there, Jason. Nancy's going to get back to a little bit of investing. And she says, for large lump sums, what are your thoughts on investing in a broad portfolio? And she gives some ETF examples, VFV, XIU, VIU, for example, or approximating a CPP portfolio. If an individual can approximate some of the private wealth in a CPP portfolio, that would be, Nancy, if you have a large enough sum to be like buying like copper mines in Argentina or something, we need to chat. We need to become friends. I'm joking, obviously, because these are the type of investments that like someone like the CPP would have access to. But Jason, what do you think? Large, does it matter the size of the lump sum when you're looking at?
I don't think so. Large, small. I think it's more. It boils down to like investment philosophy. The ticker symbols that Nancy has listed off here. These are exchange traded funds. VFV, I think, is a Vanguard fund that follows the S&P 500. XIU is an iShares ETF that tracks the TSX 60, and VIU, I can't remember. That's a Vanguard ETF that tracks some other index. But I think if somebody is wanting to be a passive investor and buy the entire market rather than trying to figure out which of the 500 stocks on the S&P 500 to buy, small or large, index investing is one approach, and it's an easy way to invest your money as a self-directed investor. It's tough building a portfolio of individual stocks, and most people that I meet are not very comfortable with it. So I'd say the majority of self-directed investors, in my opinion, if you're not going to work with an investment advisor, probably should consider having some or all of their money in ETFs. Approximating a CPP portfolio, kind of tricky. They've got not a ton of money in the public markets. They own malls and copper mines, as Kyle referred to, like private equity. They've got, I think on the March 31st, 2023 report for the CPP, I noticed they've got about 33% of their portfolio for the base CPP anyways in emerging markets. I don't see a lot of people with emerging markets exposure in Canada, but approximating the CPP portfolio is tricky, and getting access to private equity and real estate and alternative asset classes can be tricky for a small investor because the fees tend to be high. So again, it's a philosophy thing, I think, at the end of the day.
Just to flesh out what Nancy's going with, I Googled as you were talking, Jason, VIU is ex-North America. So what she's done there is she's got...
the three of them together.
I see what you're doing, Nancy. You're trimming as much MER as you can, right? So what you did is you chose low MER US stock exposure, low MER Canadian, and then in everything else. And so I think maybe like... I know just from talking to Jason, our views are on active versus passive, which I know you were around when we had that discussion an hour ago. We're pretty similar. And So you obviously have bought into the passive at this point. I don't think the size of the portfolio matters unless you're into like the $1 billion range of some kind, where you might be looking at different. By the way, the CPP isn't sure that all those other things are actually going to add value. They hope, and probably it'll add some degree of variance separate from what stocks and bonds are doing. But I'm not sure that it is actually adding value, especially when you look at their fees. Now, I think your question actually might be, when you look at how you're going to do this in your online brokerage account, should you basically create your own all-in-one portfolio like you did right there, or should you just buy an all-in-one ETF, or maybe even a robo-advisor, go with a robo-advisor, which is basically going to just shuffle those 3 ETFs or a variant of them on your behalf. And we have had a couple summit sessions on that. And basically what it boils down to is you're saving about, versus an all-in-one ETF, you're saving about 0.10% MER by doing all of the rebalancing yourself. Maybe slightly more if you've got a bit of a Canadian bias in there, just because it'll be a little more tax efficient. But you've got to be pretty into optimizing, Nancy, for that to pay off for you. Not to say you shouldn't do it. 0.1 is 0.1. And if you got $1 million portfolio, that's a decent chunk of change. But I don't know. For me personally, I make the argument in the course that the all-in-one it's pretty tough to beat from a convenience perspective. I don't know, Jason, you've worked with many different types of clients. Is that kind of consistent with best practice?
Yeah, I mean, I think so. These all-in-one ETFs, which these days you can buy through, Vanguard, iShares, BMO, Horizons. There's lots of options out there to buy an ETF that would give you Canadian, US, international exposure, bond exposure in differing percentages, where you don't need to buy 3 or 4 or 5 individual ETFs. So I think it depends, if you are a more sophisticated investor where you want to buy and rebalance the individual ETFs like you're suggesting, Nancy, you could do it. But all-in-one ETFs, I think, particularly as they gather assets, the fees will probably come down a fair bit, and it can be a much simpler way to manage an ETF portfolio.
Okay, we're going to look at a bit of a different one here, Jason. Sam asks, Mom has 100% gifted me a house that she inherited with no mortgage, and I've been maintaining for 20 years. I'm looking for a general strategy to make things fair with the other 2 siblings. So I assume you mean, Sam, that you're trying to look at this as a pot of assets, so to speak, that you want to equally divide between the 3 of you. That's, I think, my assumption based on your question. I'm not sure what the most tax efficient way to do that is, other than you gifting money. I'll let Jason try to take this.
Yes, an interesting one. So it sounds like Sam has had the property 100% in their name for the last 20 years, which would be uncommon, especially if there's 3 kids, right? Like, you figure it would be in all 3 of their names. So I don't know if there was a specific reason for just having it in one child's name or one sibling's name. If the original intention was such that it was meant to be for all 3, there may, with an asterisk, be an argument that Sam has been holding the property in trust for the 3 of them over the years, and there may be an opportunity to just register the property in all 3 names as it should have been all along. But that might be difficult to argue, particularly if it was a rental property that was being reported on Sam's tax return or without some substantiation otherwise. If you own a property that's 100% in your name and you transfer it to anyone who you don't deal with at arm's length, so generally a family member, like in this case siblings, there would be a capital gain that's triggered on the transfer, even if no money changes hands. That doesn't matter. It would be based on the fair market value of the property at the time. If the property happened to qualify as Sam's principal residence, I can't tell. Maybe Sam's been living there and it is Sam's principal residence. Maybe the capital gain is sheltered under the principal residence. exemption. So I think it kind of depends on the exact nature of the situation.
Yeah, there's a lot of variables there, Sam. Kudos to you for wanting to sort of make things equal on your own terms, but it would really depend on the terms in which you, were ascribed the house or inherited, or I'm not sure. Yeah. Okay, Kirk, this is a follow-up, Jason, from Kirk. He had a question in regards as to what income splitting was. So now he's drilling a bit deeper. He's retired at age 65. He said, what are the eligible pension income splitting rules? Would a lump sum RRSP withdrawal qualify for that? How about RIF? Go ahead and answer this. This is right in your wheelhouse.
Yeah. So the short answer is RSP withdrawals will not qualify. There are certain types of income that qualify as eligible pension income. Eligible pension income can be split up to 50% with your spouse, and it's not all or nothing. It can be 0, 50, any percentage in between. And the reason that you might split eligible pension income is to try to equalize your incomes or minimize your combined tax. So RSP withdrawals will never qualify. RIF withdrawals, once the account holder is 65 or older, those will qualify as eligible pension income, up to 50% of which can be split with a spouse. I saw a similar question there from somebody else on LIRA withdrawals. And it was LIRA withdrawals. Yeah. LIRAs, just to be clear, you cannot take a withdrawal from a LIRA. You need to convert a LIRA to a LIF or an LRIF or a similar type of account. In most provinces, you convert a LIRA to a LIF, a life income fund. And from age 65 onwards, those withdrawals would also count as eligible pension income. Depending on the province in which you live, your locked-in account, your LIRA or your locked-in RSP gets converted into different types of withdrawal versions of those accounts. Check out the locked-in account video that Kyle will be sending out that I did, and that'll have a lot more info.
One other thing you might want to consider, Kirk, is it's a lot of Canadians think that an RSP conversion to a RIF is all or nothing, and it's not. You can just convert a portion of your RSP to a RIF, and there's two really good. There's a few different reasons and trade-offs, but the two really good ones are there's if you don't already have a pension of some kind, you're going to get access to a pension tax credit through that RIF income, and you'll be able to tax split as we were income split, as we were just referring to there. So you could, if you wanted to keep putting money in on the RSP side, and then also have the separate RIF going, it's not an all or nothing thing. So just something to think about. So we've been talking a little bit about swap-based ETFs today, Jason, just to give some context here. Vadik asks, what are the risks with swap-based ETFs? Could an unfavorable ruling in the future force shareholders to retroactively pay taxes on what would have been interest or dividends? Thoughts on the counterparty risk? I did my best to explain the logistics of a swap-based ETF and counterparty. So this is a real good question based on that. Take it. Go ahead, Jason.
So maybe just do a quick refresh for anyone who's tuning in now. So a swap-based ETF, as simply as I can explain a complex topic, there are ETFs in Canada, predominantly from a company called Horizons. There are ETFs, more often in other parts of the world, where rather than a physical ETF, when you buy an exchange-traded fund that tracks the S&P 500, most ETF companies will go out there and buy the 500 stocks of the S&P 500. It's a physical ETF. They own the physical shares of the underlying companies. A swap-based ETF is an ETF where they don't actually buy the shares. It's what they often call a synthetic ETF, because they're entering into a complicated financial arrangement, typically with a bank, that just promises to pay the return of a certain index. So it's a little bit more complicated, arguably a little bit more risky, because if the counterparty, the bank into which you're entering this contract, cannot make good on the on paying the return, there is some theoretical risk. I think in Canada in particular, the counterparty that Horizons uses, for example, as I understand, is National Bank. National Bank, the likelihood of national bank having financial difficulty is probably pretty low compared to a financial institution in another country. But most other, I shouldn't say most, some other parts of the world, like in Asia, for example, I know that swap-based ETFs, synthetic ETFs are much more common because they're cheaper to run. They have less tracking error. And anyways, enough on what a swap-based ETF is.
Yeah.
Could an unfavorable ruling in the future force shareholders to retroactively pay tax? I would be shocked. I can't imagine the Ministry of Finance introducing something in a future federal budget that said, okay, we're going to go back and you need to change your tax return for all previous years. I think that would be possibly literally, impossible to happen, but certainly very unlikely to happen. More often than not, when there's a change made, it's from today forward or from January 1st of the current year forward, or in a lot of cases, there's notice given, and as of such and such a date or a year, this change will apply. So, I mean, I wouldn't be surprised if at some point a swap-based ETF or similar investments that turn interest and dividends into capital gains income and allow people to pay less tax gets changed. I don't think it would be retroactive. So, something to look out for. I mean, certainly anything that can be done to raise taxes is always on the table. So
yeah, as I can say this much, Vidiq, when I read into it and looked into it and talked to maybe even to Jason, Dan Bertolotti was another fellow I talked with. I got to interview someone from Horizons as well. I personally used HXT in my own account when I was overseas as an expat, just because of the difference in dividend taxation. And I didn't feel the counterparty risk. Like when I looked into it, National Bank would almost have to be going bankrupt if for them to not pay that out. And even then, it was unclear as to like what how the corporate stakeholder responsibilities would shake out. But it basically was the same risk as like having a bond from National Bank or having your money in a bank account at National Bank was what I was told. So anyway, that's the risk level, I guess. And yeah, if it ever does get changed from that moment on, I would assume just swap my money into a basic plain vanilla index. If I were in the same situation overseas and still had it, and then I just eat the dividend tax that everyone else does from then on. So here's another housing gift question. Mom intends to gift me a house that we both live in with no mortgage. Do you advise that I open an FHSA and buy the house with the proceeds in 5 years with the balance of that time? So I guess this would be a way to almost like basically what I think you're doing here, Ryan, is you're more or less creating a tax advantaged investment account for your mom. Essentially is what you're asking. I don't know. What do you think of that one, Jason? That's kind of interesting.
So it sounds like what Ryan's looking to do is open up a first home savings account, which you can contribute to and claim tax deductions, and then take a tax-free withdrawal to buy your first home. Doesn't need to literally be your first home, just needs to be a case where you or your spouse or common law partner has not owned a home that you've lived in the last 5 years. If the home is 100% in your mom's name, I think that you probably could do what you're suggesting, contribute to an FHSA, claim some tax deductions, pull the money back out. And I think that could work. I don't see a problem with that. I mean, basically what you're doing is you're taking money that you might have otherwise given to your mom, and you're creating some tax refunds on that same money with no other implications. It's an interesting situation that I haven't thought of before. It would need to be, I think, a legitimate scenario where you were buying the house from your mother. You did mention gifting the house to you. So I think you may run into a problem if, you're buying the house from her and then she's turning around and gifting 95% of it to you because you've really only bought 5% of it. So there might be some nuances there that makes this offside if you're not legitimately buying the home and you're just trying to manufacture tax deductions. I guess my answer is it might work, but there might be some issues there.
Yeah, and I guess it would depend on how you balance out, like, yeah, if your mom intended to gift it to you, what's her tax situation? Because then the house is going to be deemed disposed at that time versus you taking out a mortgage and possibly buying the house or for part of it. Or yeah, I'm not sure the juice is worth the squeeze there. Maybe if you're in a top tax bracket, maybe the money you're saving could be substantial there, but you're probably going to need to get an accountant and a lawyer involved, I would think.
Yeah, I think you have to look at the specifics on the FHSA account. I feel like there's, if it's not like an arm's length purchase,
that could
you
be.
might run into problems buying real estate, or, again, especially when you're not literally buying it, you're maybe kind of buying it. If it's being gifted, no way. You need to literally buy the property. So again, could you structure a transaction where you bought it from your mom at the fair market value? Maybe, but then she'd be turning around and gifting you part of it from the sounds of it. So I don't know. I think you'd have to look at the exact rules on FHSA, which I've not delved in that deep on a nuance like this.
Pretty tricky. Okay, Cassandra has another question for us here. She was about the informal trust as well. So she's stay-at-home mother, husband is the main breadwinner. Whose name would it be best to invest under if we borrow to invest? Saving an income tax versus the interest deduction from borrowing. Can we pick if the money's under both of our names? And I think she means HELOC there.
Yeah. So, borrowing to invest, what you're trying to do is you're trying to invest at a higher rate of return than the interest rate you're borrowing at. And if you borrow, in this type of market at 7% or more interest, and say you could invest the money at 9%, not that I think that's a reasonable assumption, but you're making a 2% profit on the spread. So if you can earn that 2% profit on a high income person's tax return or a low income person's tax return, I'd rather earn that on the lower income person's tax return. So I'd say there might be a slight benefit to earning it on your tax return, Cassandra, but it kind of depends on what you're investing in too, and exactly what your respective incomes are. Because if you're investing for capital gains, you're buying, investments that pay your Canadian dividend income, and it all kind of depends on what you're investing in. But I don't think it's a compelling decision one way or the other. We're asking about, let's see here. Can we pick if money is under both names? If you're borrowing using a home equity line of credit and you both contributed to the purchase of the property, in relatively equal amounts, you could borrow and invest into a joint account, I suppose. But again, I don't know if there's a huge advantage to whose name the investing is done in. And frankly, I think more importantly, my concern is right now borrowing on a home equity line of credit, which most HELOCs are at 7.2 to 7.7% right now. I don't know how much profit there is to make on a leveraged investing strategy. Over the long run, if you look back over the last 20 or 30 years, North American stocks have returned sort of 8.5 to 9.5% annualized. That assumes somebody has a 100% stock portfolio and no investment fees. So, how much ability is there to make a profit on the spread? I'd be hesitant to borrow to invest at the best of times, but certainly right now when interest rates are where they are.
Okay, good stuff. We got Nancy Grouni will be joining us momentarily. We're just getting her connected here. And so if you're just tuning in to see Nancy, obviously we got Kyle and Jason. Jason from Objective Financial Planners, Nancy also from Objective Financial Planners. And I'll just take the opportunity here as Nancy's getting the audio visual hooked up to say if you want to work with either Nancy or Jason or one of the other members at Objective Financial, just head on over to objectivefinancialpartners.com and see what they've got. Jason, why don't we give you like 30 seconds here to tell us what it's like if someone comes to Objective and they're not sure what they want to do?
Look, I think the main thing is we don't sell investments, we don't sell insurance, we don't sell any financial products. We're not affiliated with anyone who does. We operate more like accountants or lawyers. People buy our time, and in some cases it might be a simple situation like the gentleman in Alberta who was trying to make a pension decision. In some cases, in a lot of cases, it's people coming to us and saying, look, I'm hoping to retire in a few years. I need to develop a retirement plan. And that's really one of our main expertise. We typically have these days a Zoom meeting with a prospective client, try to determine if and how we can help, put together a personalized written proposal for services outlining our fees. And if and when they decide to move ahead, we give them a little bit of homework to do and we get to work. Some of our clients we work with once and never again. Some of our clients we work with every year. I've got clients I've worked with for 20 years straight. And then there's some people that come back every few years. So we're pretty flexible and work with clients all over Canada and around the world.
Okay, great. Thanks for that. So I'm just messaging with Nancy. We're going to take another question here from JL while we wait for Nancy. He asks, what are the tax implications on converting the RSP to the RIF at age 70? Is there any benefit to converting earlier? There are a few. Go ahead, Jason.
So converting an RSP to a RIF on its own is not a taxable event. When you convert your account, the investments typically get transferred from one account to another in kind. So whatever you owned in the RSP gets transferred over to the RIF account. No tax payable. The tax implications start the next year when you are required to take minimum withdrawals that are based on your age and a percentage of your account value. So is there a benefit to converting earlier? For sure. I'm a big fan, particularly if somebody retires at a relatively young age in their 50s or 60s, to taking early withdrawals from their retirement accounts in an effort to smooth their income out. The idea being if you retire and you're just drawing down your bank account and your TFSA and your non-registered investments and your RSP account continues to grow, you might have a situation where your income's fairly low in your 60s, spikes up in your 70s, you're paying a lot higher tax rate, you're losing access to government benefits like your old age security pension. And, if you're married and one spouse dies at a relatively young age, it could push the survivor up to an even higher tax bracket. And if you die having a relatively large RSP or RIF account, over 50% of the account could disappear to tax, depending on your income in the year and how much you've got in there. So I think there's definitely some benefits to converting earlier, just to try to smooth out your tax rate and pay less lifetime income tax. We also talked a little bit about the opportunity to split income, RIF income with your spouse starting at age 65. So RSP withdrawals don't count, RIF withdrawals do. And there is that pension income amount tax credit. It's not huge. It's $2,000 of eligible pension income that if you're taking RIF withdrawals or you've got a defined benefit pension or whatever, that $2,000 can be tax-free or close to it. It's not big tax saving, it's a few $100s, but if you're going to start to take withdrawals from your registered accounts anyways, converting your RSP to a RIF much earlier than the age 71 that some people wait to can be advantageous.
Okay, guys. Nancy is just momentarily still getting her laptop up and running there. So if Jason's okay, if he's got the time, we'll just keep buzzing through a couple other questions we had here. I actually had a pre-summit question that if we had time, I wanted to get in, Jason. So Here
Sure.
was one from Anne. We still would like to be earning money on our investments. We're 68 and 67, I believe. Oh, probably not 68 and 7. Should we be looking at having an advisor to help us make financial decisions in our portfolio? Obviously, Jason is an advisor, but Jason, when you talk to people, I guess maybe if Anne came to you, what questions would you ask Anne to try and ascertain what level of help she actually needs?
Sure. So maybe just to clarify. So again, I don't manage investments. I'm a certified financial planner. I focus on financial planning, retirement planning, tax planning, investment strategy, but we don't manage investments. When we speak to a client and we're trying to figure out, answer a question like this effectively, my questions would be, what are you doing currently with your investments? What are your goals? Some clients come to us and they have existing investment advisors, and they might be doing a great job and they're very comfortable with them, or they might be a little bit uncertain. The fees might be high, the communication may not be great, and we can help them explore other options. But it's not uncommon to find a situation where someone's managing their own investments and they're not quite sure as they get older whether they want to continue to do it on their own. So they might be at a point where they're looking to hand over the keys to their portfolio. I think that it's definitely better to explore it sooner rather than later. I've seen cases where people have waited too long, where it's harder to make decisions, where eventually it's their kids that are jumping in and trying to help them decide what to do with their money. And at least that way you can kind of vet and select an advisor while you're still well capable of doing it, and then hopefully have a relationship that will last many years into the future with somebody that you and your family can trust. So there's no right or wrong answer, but I think if you are getting to a point where you're looking to pass over your portfolio in the next 5 years, it's probably better to start today and lay the groundwork for the eventual transition of your investments.
All right, that makes a lot of sense, Jason, and thanks for that. We're pleased to welcome Nancy Grouni with us today.
Hey, Nancy.
Hey, Nancy.
Thanks for your patience.
Yeah, thanks for joining us. As I was saying, Nancy
Happy to
is
be.
from Objective Financial Partners as well, and offers a wide variety of financial advice there as well. We asked her today to maybe if you had any specific questions at the intersection of corporate and personal finance. But are you game to take questions from pretty much anywhere as well, Nancy?
Sure, I'm open, absolutely.
Okay,
We're all over the place today.
Yeah.
Yeah, we've had some interesting ones. Okay, we'll just continue going down, Nancy. Basically, how this works, folks, if you just tuned in, is any of the three of us can take the question, but basically you just type it in YouTube, and you only get 200 characters, but you just type it in as a question or comment. I'll pop it up here, and then I'll leave it to the experts to answer. So Jack asks, when preparing a financial plan, how do you go about ensuring a holistic approach over time, i.e. pensions, assets, tax implications, and passing on money efficiently? Do you offer scenarios?
Wow, that's a great question. Absolutely. When preparing a financial plan, it's really important to have a holistic approach. I mean, really, that's the whole point. We're looking to incorporate personal assets, corporate assets, if they're in existence, as well as pensions, etc., to better understand how everything will come together, especially as you retire and begin to draw down on those assets. And so holistic planning, in my opinion, really looks at not only your current tax rates, but also your future tax rates on an inflation adjusted basis. And that kind of information is incredibly invaluable, and it really helps drive a lot of informed decisions today.
Yeah, I think a lot of times, just to chime in on the scenarios comment, like we'll get clients that'll come to us and they're not sure if they want to retire in 2 years or 5 years, whether they want to downsize their house, whether they want to make other decisions. And we can use financial planning software to try to model out different scenarios and test them and try to show them, holding these 100 variables constant, here's what the future looks like. many of those variables will change a little. Some of them will change a lot. And I think that's the most important thing about when you get a financial plan, whether it's from us, whether it's from somebody else. A financial plan, I mean, we do financial planning because life changes over time. There's differences in tax rules and investment strategies and just the outcome of your investments and things that happen in your life and in your family's life and things like that. And look, we're biased. We sell our time. We would like to work with people on an ongoing basis. But in fairness, life changes, and you don't necessarily need to work with a financial planner every year. You don't necessarily need to do a financial plan every year, but I think revisiting it over time is definitely very important.
And, I would just add to that as well, that where I use scenario planning quite a bit is in helping clients understand, for example, maximum sustainable spending. So we'll do perhaps one scenario at a lower spend rate and another scenario at a higher spend rate. And it might be determined that, hey, we can actually afford to spend a little bit more. Why are we being so careful with our money? We're underspending potentially. Or perhaps, we want to evaluate two different tax strategies, two different financial planning strategies, when to begin CVP and OAS, when is the best time to begin RIF withdrawals, etc. And so having those scenarios side by side can be incredibly useful in determining some of those answers to those questions.
Yeah, I feel like the scenario planning gives folks kind of something concrete, as opposed to the theoretical. We can get into the weeds pretty quickly as kind of finance money geeks in terms of discussing based on this rate of return. If two different scenarios or multiple scenarios, I agree, obviously makes a lot of sense. Here's a corporate related question that I got before we came online today. Okay. And I think based on Thursday's discussion, I think maybe we'll bring in Nancy to do some more detailed work on corporate stuff next year, because I've had a lot of questions that kind of sound something like this. My husband and I have $200,000 in a corporate account. Our RSP, TFSAs, and RESPs are maxed out. So we want to invest within our corporation. Are there certain types of investments, such as swap-based ETFs, that are better for corporate accounts? I've been told, and they ran out of space there, but I've been told that Canadian equities are not good in a corporate account. And then they said, what about US equities? So
interesting. Yeah, there's so much in this question.
Yes. Yep.
Definitely. So I would say, right off the bat that there's, we need to make a distinction between personal investments versus corporate investments, because the tax rules are entirely different. It really isn't sort of an either or type of scenario. Many business owners have both. They have corporate investments and they also have personal investments. So in this case, just because your RSPs, TFSAs, and such are maxed, you don't have to wait till they're maxed out in order to invest in a corporation, is what I'm trying to get at. But essentially, yes, if you have funds accumulating in a corporation, you should absolutely invest them. Invest those assets, because you want those assets to grow. Really, you're your own pension fund. You can kind of look at it that way. Now, as far as how best to invest in a corporation, yes, there certainly are a variety of tax efficiencies to be considered when it comes to investing. So will you invest using, with interest, dividends, capital gains in mind? Capital gains is often a fantastic way to invest in a corporation, with focusing on capital gains, because 50% of a capital gain basically funds a notional account inside your corporation called the capital dividend account, and allows the funds to flow out tax-free. When it comes to some of these other instruments like swap-based ETFs, I have heard some clients mentioning that this is really a preference because they're concerned about not having access to the small business rate, because there is a reduction in the small business rate if your passive investment income inside a corporation exceeds $50,000, with a full reduction clawback at $150,000. So I assume that this is what what we're getting at here, but it's actually that's actually a really interesting thought as well, because it depends on the province. This really isn't so much of a concern in Ontario because provincially the rules, provincially there was no follow through with the SBD. It's really only federal. So with the reduction of the SBD and passive investment income, so it's really not as big a deal as what I'm trying to say as a lot of people make it out to be. So I'm not sure I would completely, adjust my investment strategy for this particular reason. But really, I think planning on a holistic basis, looking at interest, dividends, capital gains, particularly in a corporation, it would be a focus on capital gains and Canadian dividends in terms of tax efficiency.
Absolutely. I'll kick in. This one is kind of playing in the same ballpark, Nancy. Ryan asks, how does a corporate holding company work, especially during retirement? Can it be used to maximize government benefits such as OAS and GIS even for a few years? By the way, I have no pension and RDSP. And just to give some context to this, if Ryan is a longtime Canadian Financial Summit watcher, Ed Rempel has done a couple sessions on how you can use a TFSA and corporate account as kind of stores of asset value that don't impact your yearly income and consequently can get you below that GIS threshold. So my guess is that's where Ryan is commenting from that direction, but that's only a guess, and I'll let you two take it in whatever direction you want.
Sounds good. Yes, I mean, the great thing about a corporate holding company and how does it work? Well, it's a corporation. A corporation is a corporation is a corp. So whether it's an active business or whether we're talking about a holding company, we're talking about the same structure. It's just that a holding company, really its purpose is to house investment assets. And that's really the main function of a holding company. And so typically what happens is when someone is retired or requires the funds, they are able to draw dividends from the holding company in order to fund their lifestyle. But they're not mandated. They don't have to withdraw dividends from a holding company. This is completely discretionary in nature. And so it can be that there's some, ability there to say, okay, because I'd like to maximize my old age security, GIS, then I'm going to limit dividends from my corporation for a period of time, and then, increase the dividends later on. So you have much greater flexibility, I would say, with a holding company.
Yeah, I think you outlined an interesting angle there, Nancy, earlier about the $50,000 to $150,000 range there. That I think that would start to get relevant for a lot of folks that are considering kind of, I would call this an aggressive strategy. Am I wrong in saying that? Like if you're looking at taking your annual income below that GIS, I would consider that a fairly aggressive strategy. I could be wrong.
Yeah, I mean, you might need to be, depending on your marital status and your age, you might need to have less than, roughly $15,000 or so of income. Like you can certainly do it by withdrawing from your tax-free savings account, or, maybe your corporation has shareholder loans that are owed back to you tax-free, or you've got a capital dividend account like Nancy referred to earlier, where you can take a tax-free capital dividend out of your corporation that doesn't push up your income on your personal tax return. So, there might be ways to manipulate your income and have it be low enough to qualify for the GIS, guaranteed income supplement, but you've got to be fairly low income in order to qualify for a few years. Old age security is, I find, less of an issue. You need to have income of over about $87,000 for 2023 to have any potential reduction in your old age security pension. And I think one important thing to sort of distinguish here is that a corporate holding company, if you've got a business that you're running and you're earning income and you're moving investments over into that holding company, that's a great tax strategy because it results in you not having to take money out and pay personal tax. using a corporate holding company and setting up a corporation and transferring your personal investments into that corporation may not be worth it at the end of the day. I mean, could you do something like that in order to reduce your income and qualify for guaranteed income supplement? I suppose, but then you've got legal fees, accounting fees, complexity. You got to pull the money back out someday. Like normally people won't set up a holding company for their personal investments. They'll have a holding company because they ran a business and earned corporate income that they didn't need for their lifestyle, and they were able to save in the holding company.
Okay. I think that was pretty thoroughly answered there, Ryan. Andidi asks, how do you register a side gig for a temporary resident in Canada? This implies that one has a work permit, but not a permanent residency or citizenship. So I guess the question becomes, can you open a corporation if you're not a permanent resident or a citizen? Or would it just be other professional income, I guess?
Yeah. So, I mean, I'm happy to chime in on this one. I work with quite a few non-residents and people with cross-border issues. But if you are, so first things first, if somebody's doing a side gig, I would think twice about registering a corporation, because corporations cost money to set up, money to maintain, legal fees, accounting fees. You know, normally it's better if there's a lot of liability, you're going to be earning a lot of income, or you're going to have partners. So for most side gigs, you can operate as a sole proprietor, and the income and expenses just get reported on your personal tax return. As long as you're operating under your own legal name, you don't need to register anything with the province. But if you're like, you know, Adidas Consulting, you might need to register the business name, for example. And I know in Ontario, it's like $60 for a 5-year business license. You might have HST implications if your income exceeds a certain level, $30,000, where you need to charge and collect HST. But otherwise, if somebody's earning like 5 or 10 grand of income in their personal name, they're not marketing under another name, you can just do it personally and report it on your personal tax return. I don't know a lot about the immigration rules and work permit and permanent residency, but I assume a work permit would permit somebody to work in Canada and would not have any restrictions there. As far as I know, there's no reason why a non-permanent resident, non-citizen couldn't have a side gig and run it as a sole proprietorship and have it taxed on their personal tax return. Because Canada taxes residents on their income. So when you're here, you're living here, you pay tax on your worldwide income. Okay,
there you go, Didi. This one's over my head, so you guys can take this one. Scott asks, I have two, I assume that's corporations with 100% stocks in each, two holding companies, two holding corporations. There we go. With 100% stocks in each one. I plan to divest these to my children. So I assume we have two children, ages 15 and 18. He plans to divest these in the future. Should I combine the two holding corporations to reduce yearly accounting fees? Thoughts on share structures? That's a tricky planning without knowing anything else about Scott's personal.
Yeah, I would just say, first of all, at a high level, whenever you work with a client that has multiple holding companies, I do always consider that question: is it possible to amalgamate? Just because you are paying additional accounting fees, and it's year in and year out. So it's an expense that really may be unnecessary. But having said that, it's really not that straightforward. You have to look at what's going on in those individual holding companies, look at the financial statement, the corporate tax return. And so this would be something that a tax accountant and perhaps tax lawyer would need to weigh in on as far as the share structure. But assuming that the holding companies are plain vanilla, 100, as you said, 100% stocks, the same share structure, potentially they could be amalgamated, and that would save you some fees. I think the question about divesting them and having your children participate in the growth of these assets, or even gifting these assets to your children, is another question altogether, because there is some complexity there. So There is a tax strategy called an estate freeze that many clients do move forward with. And that is a way to freeze the growth, the current market value, the fair market value of the corporation, attributes to the parents, and then they bring in the kids in the share structure, and essentially the future growth attributes to the children. So we're talking adult children. So there could be a potential there to include children, adult children, and perhaps even have a family trust structure. But there are a variety of nuances there around there are some tax complexities we'd want to make sure that additional tax did not apply, or tax on split income would not apply.
Okay. Moving on to a question that I got before we open the summit window here. I have a question regarding professional corporation. I currently have a professional corporation which I pay myself a salary and therefore contribute to CPP. At retirement, what is the best way to pull the money out? Do I deplete the personal corporation first, and then they write in a lower tax bracket, and then take the CPP later in life?
It would be great if it was as straightforward as that, but it really isn't. There's so much loaded in this question here. So I actually work with a lot of clients who have professional corporations and are facing this exact question. They are, retiring and contemplating retirement, and they need to know how best to decumulate in a tax efficient manner. So we would never just look at assets in the professional corporation. We would consider personal assets as well to see how they best integrate in terms of mapping out your tax rates, current and future inflation adjusted tax rates. So timing of CPP and OAS and RIF payments, all of that needs to be integrated with the assets inside a corporation. As far as drawing assets from a corporation are concerned, really you're looking at drawing dividends. Some professionals continue to pay themselves a salary in retirement, but probably shouldn't. Really, in terms of tax efficiency, we're talking about paying dividends, not either non-eligible dividends or eligible dividends. So there are three main ways that you can draw money from a corporation. As I mentioned, either an eligible dividend or a non-eligible dividend, or it can be a capital dividend, which is really preferred because it's tax-free. And whether, which you should withdraw and when is a function of a whole bunch of other factors, which really comes down to some of the notional accounts in the corporation. But what we're really looking to do is to lower your overall tax payable during your lifetime.
Yeah. Any thoughts on the idea of the deferment of the value of deferring the CPP versus? I know it all has to be tied in, but is there certain scenarios that you find yourself recommending more than others in terms of the deferment being the recommendation, as opposed to take it now and we'll just plan with that income stream as well as the dividends from the corporation?
Yes, typically we would absolutely look at CPP deferral of CPP, just because there's a 42% increase, right? If you defer from age 65 to age 70. So it may be beneficial to do so. We would also look at potentially drawing down on RSP assets or RIF assets first. Potentially some of those scenarios look best even before drawing dividends from the corporation. So it's really quite a fascinating topic. And again, I think this is where scenario planning can be incredibly useful.
Okay, I got another one for you guys as financial planners. So I got this question earlier in the day today, and JL, I could speak with some degree to the fact that CFS, as far as I'm aware, is definitely not tax deductible. I said maybe if you had some sort of a day job as like a money coach or something, you could call it a professional expense, but certainly not as an individual. Now, if folks come to Objective Financial and ask for a quote and they purchase your time, is that tax deductible?
I'm going to say Generally speaking, no. And there's some confusion on this topic because you can deduct on your personal tax return expenses for carrying charges, which often includes investment counsel fees, like fees that are paid to someone who's managing your investments. So a lot of times people think you can deduct any sort of financial fees. And technically, if you look at the letter of the law, financial planning fees are not tax deductible to an individual unless they relate to investment management and custodying your assets, which we don't do. So for most personal clients that we have, our fees are not tax deductible unless maybe they've got a rental property or a sole proprietorship, and some of the fees might be attributable to those assets and that income. If a corporation pays for retirement counseling for an employee, those fees are generally tax deductible to the corporation, but are not considered a taxable benefit. So, for example, if we have a lot of clients where they're corporate clients and their employer might pay for them to work with us, for example, that may be a case of where the fee is tax deductible to the business and it's a non-taxable employee benefit. Likewise, if somebody has a corporation of their own and the corporation pays the fees, likely tax deductible to the corporation, tax-free employee benefit. But it's tricky because retirement counseling, employee retirement counseling is kind of a vague term. And, sometimes the advice could lead into other non-retirement related things. Like say we're helping interview portfolio managers or something like that. I would say a portion of that fee would not be, it would be tax deductible to the corporation, but would be taxable to the employee as a employee benefit. So generally speaking, no, but when it's paid by a corporation, maybe.
Okay. So Scott's back. It said, thank you for the previous answer. Thoughts on universal life policy to cover probate fees when transferring corporate assets to children? And just to give you guys some context, I was answering some questions on someone had been advised, the question I answered earlier in the day today, someone had been advised they had a term life insurance plan. And for the last couple of years, their advisor had been really pushing them to go with a whole life policy and didn't give them any background. So I was pretty hard on whole life and different types of participating life insurance, just to give you the background of where this might be coming from. But yeah, sure. How do you guys work in whether it's on the corporate side of things or to offset tax liability as far as life insurance policies go?
Yeah, this is such a great question and one that I frequently get. And this is where, honestly, I think planning is so incredibly helpful because it really comes down to the trajectory of the assets in the corporation. So I run a lot of plans where, you know what, they're pretty much going to be depleting all of their assets, all their investment assets in the corporation, sometimes way before life expectancy. So is there a point in having universal life or whole life? Not so compelling, right? Because then you can be in a situation where there are no assets in the corporation and you've got this universal life policy that maybe was, too costly to fund to begin with, draining the corporation even faster. And then the clients say, okay, well, you know what? I want to close down this corporation because I want to save annual fees. Well, nice try. It's actually super tricky because that policy then has to be valued. You can't just draw it out. There are major tax implications. And so there are situations out there where clients have to keep their corporations around just because they have an insurance policy. So that's why I say it's really great to be able to put all of the client's financial information together in one place. Let's understand the trajectory of the corporation to then say, okay, is there going to have are they going to have a ton of money left over at the end of the day? Excellent. Well, now let's look at some tax strategies, and for sure, a universal life policy or whole life policy, whereby the death benefit pays out tax-free and it flows through the corporation's capital dividend account. can be a great way to cover off taxes on second death.
I might elaborate on this a little bit, because I find we often get people who are being pitched life insurance to cover, I mean, in this case, probate fees. And I think, probate fees in province of Ontario, for example, are 1.5% of an estate's value. Like, it's not a big deal. Scott might be referring to income tax and paying, like buying insurance to pay income tax.
I would assume that too. Yeah.
I find a lot of times, like, the way that I look at it, if you buy insurance to pay the income tax, you have less assets to pay the income tax in the future. Like, it's not a magical way to pay the tax. You have less money, and you'll get, your kids or beneficiaries or whatever will get some money back from the insurance company. And the thing with insurance is, insurance companies go out and they're investing insurance premiums in the more or less the same things that we could all buy, being stocks and bonds and real estate. They don't have a magic way to earn a 15% rate of return. So, buying insurance to pay tax, I'm not really a big fan of. But as Nancy referred to, when you have more money than you're going to spend in your corporation and you're not going to need it during your lifetime, buying corporate life insurance to get the money out through the capital dividend account tax-free to your beneficiaries can be a really good opportunity. That assumes, A, there's going to be more money than you're ever going to spend in your corporation, B, that you're interested, because even some of the clients we identify where they might be a good candidate for a corporate life insurance policy say, I hate insurance. I just want to have stocks and bonds and have a simple life and have control of my money. And so depends.
Yeah, that's like when we were discussing earlier, I had said it was talking not within a corporation, but I said there are very select instances where I would look at universal or whole life. And basically, for me personally, the evidence I've read would be like within a corporation, like exactly what you just said, Jason, and have the proceeds automatically buying more insurance so that it's never taxed. There's an argument for it, but it's a really complex argument, and if it's not part of that corporation, the statistic when I was researching this that blew me away was the overwhelming amount of people that stop paying their premiums at some point in a whole life or universal life plan. That blew my mind.
Cancel the policy, I think.
Yeah.
I think, right?
And that's just so costly. Maybe they're not aware of like just how costly that can be. But I don't know if you two have ran into this in your planning, but I was just like, wow, that was really eye-opening for me that people chose to either let the payments lapse or to cancel the policy.
Yeah.
For sure. I've seen situations where it's the opposite and where clients feel that they have to maintain these payments. Like,
right.
Oh, I have to deposit $50,000 a year or $100,000 a year for the next 5 or 10 years. No, you don't. But I'm amazed at how many people actually think that they're married to that. And it's a relief when they understand that, that they don't have to, especially if their cash flow situation has changed.
Sure.
So I just think it can't be emphasized enough, the importance of first getting a proper holistic plan done to better understand whether or not this is a suitable vehicle.
Nancy, I'm taking us in a bit of a tangent here, but in those situations, I know a couple of instances where folks reached out to their children who were the beneficiaries, and they worked out an interesting back and forth, because when they had went to a fee-only, advice-only planner, and they explained like kind of the sunk cost. So they actually worked out where the children were kicking in because they were going to be the recipients of this tax-free. And so the planner sort of said, look, if you guys want to look at this as an investment, they've already got however many years of premiums involved. I'm just wondering if you guys have ever worked in anything like that. It made sense to me when I seen it, but.
Yeah, I can't say as I've seen that too often, but that is definitely a possibility. It's just that a lot of these UL policies, especially that get sold for corporations, we're talking big dollars. Like
right.
They're dumping in massive dollars. And so it would be tough for kids to keep up with that. But yeah, that could be a possibility. You never know.
Yeah, I know I've seen situations where somebody's had a life insurance policy for 20 years, even if it's like just a simple life insurance policy for not a lot of money, that when you look at the amount they would have to pay for the rest of their lives, and then the future death benefit, and you compare putting the same amount of money into stocks and bonds and what it would be worth at their life expectancy. Sometimes I've seen situations where it's like, actually, it's a pretty good, sort of rate of return to continue to pay these premiums. Unfortunately, the person paying the premiums usually never benefits. It's their beneficiaries, right? They need to die for it to be a good investment, unfortunately. But sometimes when you're, deep into a life insurance policy, it can make sense to keep it. So
yeah,
for sure. And it's a forced saving strategy. It can be viewed as a forced saving strategy. I do have some clients that, spending tends to be a little bit of an issue. So they like the idea of saying, okay, we're going to earmark X dollars a year into the policies.
That's interesting. I never thought about it from that perspective, Nancy, of a forced save, almost like a forced inheritance of some kind. Yeah.
Mm-hmm.
Okay.
And then they feel good about the rest of the money that they do spend, right? Because
spend the rest.
Yeah. Actually, I could see. I'm just thinking of couples in my head, and some of the couples that actually have a hard time spending money, and that might actually be an interesting sort of reverse psychology of it. Might actually help them spend the money that is available in their budget. If they know kind of it takes away some of the guilt, even though whether they should have any guilt is a totally different discussion, obviously.
That's a whole other, exactly.
Okay, this one isn't corporate involved, but this was pitched to me before today, was emailed to me. We've talked, Jason and I were talking earlier about asset allocation, also known as like all-in-one ETFs or portfolio ETFs. Mm-hmm. Are they appropriate for non-registered accounts, especially for a retiree? I am concerned about the U.S. portion and taxation. How would you guys sort of handle this level of optimization planning, I guess?
Yeah, I think there's definitely a place for all-in-one ETFs. And I do talk about them quite a bit with my clients. When we're talking about non-registered accounts, all-in-one, there are a variety of all-in-one ETFs. And of course, the tax implications would be there because we are talking about non-registered. So you can purchase ETFs, all-in-one ETFs that have fixed income, like the bond portion, as well as Canadian, US, and international equities. So it's a nice way to diversify, automatically rebalance, as I think has already been spoken of earlier. But as far as the taxable component is concerned, for sure. I mean, foreign dividends are taxed at your top marginal rate outside of registered accounts. And so that's a consideration, whereas Canadian dividends benefit from the gross up at about 38%, 138%, and then you've got the credit. So for sure, Canadian equities, dividends from Canadian equities are taxed preferentially as are capital gains. As far as foreign dividends are concerned, there is increased tax. But there again, you'd have to look at the portfolio holistically to say, okay, could we, and as is often the recommendation, what I sometimes will recommend my clients do is that they focus on foreign dividends in their registered accounts so that they tax defer or tax shelter that portion. But at the same time, that's not to say they shouldn't have any US or foreign dividends in their non-registered account. Again, it has to be looked at holistically. The bigger picture is we're trying to diversify here, and we want access to the stock market all around the world. We want global diversification, and we don't want to forsake that just because we're worried about the tax aspect.
I'm going to chime in with sort of a contrarian position on owning foreign investments in a non-registered account, including through an all-in-one ETF. I mean, one thing that sticks out to me, and I'm not going to get the exact percentages right, but I think right now the dividend yield on the S&P 500 is like 1.2, 1.3, 1.4, call it 1.5% right now. I think it's less. And I think that the average dividend yield on the Toronto Stock Exchange is like pushing 3%. So if you can own Canadian stocks paying 3% dividends on average, or US stocks paying 1.5% dividends on average, even though those US dividends are taxed at a slightly higher rate, you're paying a higher rate on a smaller number. Your actual income tax on your US dividends might be lower than on the Canadian dividends. And in large part, it's because the S&P 500 is more tilted towards growth stocks, companies that reinvest in growing, where you're going to get more capital gains, versus Canada, which is more, a lot of companies that are not growing and just sort of pay out cash flow. So from a tax perspective, you could actually end up in a worse after-tax position by focusing on Canadian dividends in your non-registered account. So
yeah, one of the interesting things I found as I was writing my DIY retirement investing course this year was when I talked with a lot of different advisors and a lot of different individuals, I found there was a real trade-off when it came to, because they'd always say, okay, how do I optimize my decumulation? And I would say, well, okay, there's the long answer and the short answer. And I can tell you how the tax treatment of dividends and capital gains and interest works in all these variety of accounts. And I can talk to you about the importance of diversification and what that all entails. And then we can look at, okay, putting some of your Canadian ETFs in the non-registered, and depending on what the bond interest rate is, maybe it makes more sense to put those in. And eventually I'd say, so you can do all that. And depending if it's $1 million, if there's two people and it's $1 million spread out amongst the portfolios, I did the math as a scenario, and yeah, somewhere between 1,000 to 4,000 usually in tax optimization, generally speaking, at the beginning when it's still $1 million, and obviously as it gets drawn down, it's smaller and smaller. Or you can just go all in one across all of your and all of your portfolios, and you'll lose a little bit of tax optimization. Probably, again, you're using like averages to try and plan out, but you'll lose a little bit of optimization, but it'll be automatically rebalanced and you won't have to think about anything. You'll just hit sell. And there were some, folks that are, if you're paying money for a course about retirement planning, you want to optimize, and that $4,000 is, or maybe you've got $3 million and then it becomes, worth that. But for a lot of folks, they just said, man, that's crazy. I want the convenience of logging into my brokerage account and just hitting buy or sell. I don't know how that stacks up versus sort of the trade-offs that you guys have seen in people's personal situations.
Yeah, I think everyone's different. I think it depends on the individual, and you can explore these options, and there's going to be the people who don't care, and there's going to be the people who really, really care, right? So,
right. Here's another one, and as I put this one up, I think I've scrolled to the end here. So, folks, I've got these guys for another 15 minutes. So if you got one or two more questions, we've got two CFPs here from Objective Financial Planners. So please take your best shot at stumping them and toss some questions. This was one I got before it was emailed in before today. Given that women generally earn less than men and are increasingly single closer to retirement, what steps do you suggest they take to ensure they can maximize their pensions and income in retirement? And I might even add they're single in retirement because, as Jason pointed out earlier, us fellas tend to pass away a little earlier. So I think that even lends a little more emphasis to the pensions and income question here.
Yeah, this is a great question. I think women, arguably, whether they're single or not, need to empower themselves with financial knowledge as early on as possible. So there's a lack of financial knowledge on the part of, well, so many, not just women, to be honest, but perhaps in decades gone by, there was a tendency for women to rely on their husbands to sort all this out and worry about the finances, but that's really a thing of the past. I'm finding more and more women are in the position where they're wanting to be empowered. They're wanting to understand their financial decisions. So what can they practically do? I think the very first practical step is to become informed. Look at websites like the Ontario Securities Commission puts out a great website called Get Smarter About Money, right? And they've got all sorts of tools and resources there. I think that's a fantastic starting point. And then understanding questions like, how much do I need to save every year in order to meet my retirement goals? So if that involves getting a financial plan done, well, obviously that would be one way of answering that question, along with so many other questions. Maximizing TFSA accounts, maximizing their RSP, if applicable. Do those RSP contributions make sense? For young women, I would suggest opening up an FHSA as soon as possible, as soon as they're 18, so that those assets can begin to accumulate. And with proper planning, then retirement goals are absolutely achievable.
Yeah, that makes a ton of sense, Nance.
I will say, and I don't know if maybe this is just me, but I kind of feel like if I had to speculate, I feel like at least 50% of the decision makers with clients that we work with, even looking at couples, I feel like there's more and more women that are the primary financial decision maker. Like I've got a lot of clients where they're couples, and I would consider the woman to be the more sort of proactive and involved. I mean, I don't know if you find the same, Nancy, or
for sure. Yeah,
they're probably the ones that stick to the plan and realize all the benefits, as opposed to the other couples.
For sure. Yeah, I do notice that
Yeah.
you can't say that it's more men than women these days. It's absolutely
Things have
different.
changed compared to the olden days,
Oh, it's totally different now for sure. But
Yeah.
I do find it's interesting. There's generally one of the two that is more proactive when it
For
comes
sure.
to finances. Occasionally it's both. But I do also work with many single women who have expressed exactly as this writer mentioned, that, some stress at feeling, okay, you know what? Wow, like I'm doing this on my own. But it's amazing to witness so many successful women out there who have been able to do an amazing job at saving for retirement. Some of them run their own businesses.
Mhm.
And they've got, these corporations, and there's quite a bit of complexity as a result, and they need that assistance. But yeah, absolutely. It's definitely changed these days.
The other thing that I'll say that I've noticed is I've got a few clients that, well, more than a few clients that I work with where unfortunately maybe it's a generation where men may have been more the financial decision makers, and unfortunately husbands who have died and left a widow who is not that financially savvy, again, particularly that baby boomer and sort of older generation where maybe it was more customary for a husband to handle more of the financial affairs. And I've seen some women that have really stepped in and learned a lot about money because they had to in a relatively short period of time. And for some, it's been harder and more painstaking than others. But I think when you need to, people will definitely step up and do and learn what they need to. But I think ideally, right from the get-go, you're having both partners, whether it's one or the other, or same-sex partners, or whatever the case may be. Like, I don't think we can generalize here. Both partners as involved as possible. For some people, they're really interested in this financial stuff, and they read blogs and read books and really try to learn about stuff. They might even do their own tax returns or something like that. The other spouse may not be as interested, but I think to the extent you can find ways for both to be involved. And when we work with clients, we certainly try to speak in a way that's relatively painless, like speaking in plain English and trying to bring everyone into the conversation to the extent that we can.
Yeah, that's a good point.
Sorry, go ahead and finish.
No, I was going to say that's such a good point. I'm also a big proponent of involving the other partner, the one that's not as interested, and trying to convince them that, what, this is not just like I promised, we're going to make this fun. It's interactive and it's going to make sense, and you're going to be able to ask questions, and this will be meaningful. You will walk away feeling empowered by the whole experience. And so it's really satisfying to be able to witness that.
Right. Personal finance is fun. I thought everyone thought this stuff was fun.
Right.
But
Yeah, well, probably we're preaching to the choir a little bit on that one. It's more like the folks that are watching this, go and tell your friends that don't think it's fun. But on that note, Nancy, I want to take the last few minutes here. We've had several comments in the comments section here as we've been going, just saying, "Wow, great answer. How can I work with you guys?" Let us know, like, who do you work with at Objective Financial? And what does it look like if someone emails today and says, "I want to work with Nancy"? What's the process there?
Yeah, absolutely. So our process does start with a 30-minute introductory meeting. And I do prefer meeting over Zoom because it's great. We get to see each other and I get to, understand your goals and objectives. And it's really the primary goal there of the first part of the meeting is I like to know, what are you all about? Um, what's brought you to this point here today? Have you had any other financial planning done? What are your short-term and long-term goals? And then from there, I'm happy to talk about how we can best be of assistance, initial planning that we offer, as well as ongoing planning services. So after that initial half-hour introductory meeting, it's really quite straightforward. If you'd like to work with me, what you would need to do is just basically send your mailing address. That kickstarts the whole process. You'll receive an onboarding email with a process which includes filling out a fact finder. We ask for certain information. We don't make it too onerous. I try to make it as easy as possible for my clients. I'm happy to liaise with your accountant to obtain tax documents, and I find that often makes it a lot easier. Once I have all the information, I'm in touch immediately to set up our meeting dates.
Okay, and excellent. And just to be clear, I talked with Jason a little bit about this on Thursday, but just to be clear, as far as compensation goes, I like to highlight at Objective that you guys are not recommending specific investments based on getting paid, right?
Right. That is how we're unique. We don't sell anything. We don't sell anything but our time. So there's no sale of product, which is quite unusual in the financial industry in Canada today. Most advisors do get paid for the sale of product and or they also accept referral fees. So that's another really important distinction that I find many people forget about. They ask about the sale of product, but then they forget about the referral fees. But that's kind of important too, right? Because if I'm making a recommendation to a particular professional, am I making that recommendation because I'm getting paid? Well, then that kind of skews my objectivity, right? So at Objective, there are no referral fees, and we're very proud of that. That allows us to provide truly unbiased advice.
Okay, great. Thanks again to you both. Thanks to everyone who participated in the expert question and answer here at the Canadian Financial Summit. We'll be posting this on the membership site for everyone who purchased an All Access Pass. So thank you once again to Jason and Nancy, and I hope we'll see them again next year.
Thanks so much, Con. Really appreciate it.
Thank you.